Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's get right into it. We all want to get better than average investment results, right? But here's the thing. You can't get extraordinary results by thinking like everybody else. It just doesn't work that way. So today, we're going to break down the core ideas from Howard Marks' classic book, The Most Important Thing. We're going to really dig into the mindset that makes all the difference. Wow. Let that sink in for a second. This quote really gets to the heart of everything we're talking about. Howard Marks isn't just trying to be edgy here. He's laying out a stone-cold market reality. Think about it. Once an investment idea is on the front page of every newspaper, once everyone agrees it's a sure thing, well, the big money has already been made. The profit potential is gone. This is the foundation for everything that follows. So here's the roadmap for our chat today. We'll kick things off with what's called the investor's illusion. Then we'll get into the good stuff, thinking on a deeper level. After that, we'll look at riding the market's pendulum, the power of defense, and finding bargains in fear. And we'll wrap it all up with, you guessed it, the most important thing. All right, section 1, the investor's illusion. Let's talk about the biggest trap that almost everyone falls into. You see, most investors, they see a headline, they hear some expert on TV, and they follow the crowd down the most obvious path. But here's the kicker. That obvious path, it rarely, if ever, leads to superior returns. So Marx has a name for this. He calls it first-level thinking. It's that knee-jerk, surface-level reaction. You know, hey, this company is awesome, so let's buy the stock. Or, uh-oh, the economy's looking shaky, better sell everything. It's simple, it's easy, and that's exactly the problem. Because it's so easy, it's what everybody is already thinking and doing. And this slide just lays it out perfectly, doesn't it? The first-level thinker hears bad news and just reacts. Things are bad, I'm selling. End of story. But the second-level thinker goes deeper. They ask the real question. Okay, sure, the outlook sucks, but doesn't everyone already know that? How much of this pessimism is already baked into the stock price? You see the difference? It's not just about what's going to happen. It's about what's going to happen versus what people expect to happen. That right there is the entire game. Okay, so that leads us to the big question. How do we actually do this? How do we make that jump to a deeper level of thinking? Well, this is where we need a total paradigm shift. It's about training our brains to think differently, to operate on a whole other level from the crowd. Yeah, it's harder, but it's also the only way to get those truly superior results. This little phrase right here, this is your secret weapon. I'm not kidding. Every single time you think you've stumbled upon a genius investment idea, you have to stop and ask yourself this one simple question. And who doesn't know that? If the honest answer is, well, pretty much everyone knows this, then your genius idea is probably already reflected in the price. The edge is gone. The real gold is found when you have an insight that the market hasn't caught on to yet. And look at the kind of mental workout this requires. This isn't just a simple thumbs up or thumbs down on a stock. A second-level thinker is like a detective. They're asking, okay, what's the entire range of possible futures here? Not just the one I think is most likely. And what's the probability I'm even right about this? What's the crowd thinking? And how is my view different? And the big one, how is all that crowd psychology already baked into the price? It's a much more complex, nuanced way of looking at the world. This matrix just nails it. Let's break it down. Look, if you do what everyone else is doing, if your view is the consensus view, your results are going to be average at best. It doesn't matter if you're right or wrong, you're just in the herd. The only box where you get those killer above-average returns is in the top right, when you hold a non-consensus view and you turn out to be right. But, and this is a huge but, look at the bottom right. If you're non-consensus and wrong, you get absolutely crushed. This is why being a contrarian isn't just about being different, it's about being different and right, which is incredibly hard. So this brings us to one of my favorite concepts from the book. You have to realize that markets aren't some sterile, logical machines. No way. They're driven by people, and people are emotional. The market is basically a giant mood ring for human psychology, swinging wildly back and forth between greed and fear, euphoria and total depression. And this pendulum analogy is just perfect. Think about a real pendulum. It almost never just sits there perfectly still in the middle, right? It's always in motion, swinging towards one extreme, then gathering energy to swing all the way back to the other. That's the market. It's rarely at its happy medium or fair value. It's usually overpriced or underpriced. And the further it swings in one direction, say towards euphoria, the more powerful the eventual swing back towards depression will be. Our job is to figure out, hey, where are we in that swing right now? This is such a great way to think about how a bull market feels. Stage 1, only a few sharp, forward-thinking people start to believe things might be getting better, even though it looks terrible on the surface. That's where the real opportunity is. Stage 2, okay, now most people are starting to catch on. Things are clearly improving. And then you get to stage 3. This is the danger zone. This is when everyone, your cab driver, your dentist, is convinced that stocks only go up and things will be great forever. That's the point of maximum financial peril. And here it is, the official mantra of stage 3. These 4 words have probably destroyed more wealth than anything else in history. This time, it's different. It's the siren song of a market top. It's the justification for ignoring all the old rules because we're in a new era. The second you hear someone say this with a straight face, your internal alarms should be blaring. It is almost always a sign that the pendulum has reached its absolute peak. Okay, so with all this in mind, the cycles, the psychology, what's the actual strategy? You might think it's all about making these heroic, swashbuckling, contrarian bets. But Marx argues for something, well, a lot less sexy. He says it's about playing great defense. It's about winning by not losing. This analogy from Charles Ellis is one of my all-time favorites. Think about tennis. At the pro level, it's a winner's game. Guys like Federer or Djokovic win points by hitting these incredible, unreturnable shots. But you and he, when we play tennis, it's a loser's game. The winner is usually the person who just makes fewer stupid mistakes. They just keep hitting the ball back over the net until the other person messes up. Investing, for almost all of us, is a loser's game. The path to victory isn't about hitting amazing home runs. It's about avoiding the big, catastrophic strikeouts. So how do you play defense? The number one tool in your toolbox is what's called the margin of safety. It's a simple idea, but it's incredibly powerful. All it means is buying something for way less than what you think it's actually worth. So if you calculate a company is worth $100 a share, you don't buy it at 98, you wait. You wait until you can buy it for 60 or 70. Why? Because that huge discount, that's your cushion. That's your shock absorber for when you're wrong. And trust me, you will be wrong. And this leads to a crazy paradox, one that messes with a lot of people's heads. The riskiest investments are often the ones that everyone thinks are perfectly safe. How can that be? Well, when everybody agrees something is a can't-miss investment, they get complacent. They stop demanding that margin of safety we just talked about. They pay any price for it, and they bid the price up so high that there's no room for error. The smallest bit of bad news can cause a complete collapse. So the widespread perception of no risk is what actually creates the risk. Okay, let's put this into practice. Once you understand these cycles, once you're focused on playing defense, you start to see the world differently. You realize that those moments of absolute panic, when there's blood in the streets and everyone is terrified, those aren't moments to run and hide. Those are the moments of incredible opportunity. It takes guts for sure, but this is where the real money is made. Here's a simple way to think about it. Investing is just a big, expensive popularity contest, and the absolute worst thing you can do is buy something when it's the prom king or queen. Why? Because by the time it's that popular, every ounce of good news, every rosy projection is already priced in. All the fans have already bought their tickets, there's no one left to come in and push the price up. The only direction from peak popularity is down. The smart money finds the future prom king when he's still in the library club. And look no further than the 2008 financial crisis for a perfect example of this. I mean, think back. In 2006, 2007, nobody was worried about risk. Credit was easy, housing prices only went up. It was a party. Then, bam, Lehman Brothers collapses. The market goes into a free fall. And by late 2008, the pendulum had swung all the way to the other side. People were convinced the entire financial system was going to vaporize. But that was the moment. That was the epiphany. When pessimism is that absolute, that extreme, that's when you have to be the one who's optimistic. That's when things are on sale with the biggest margin of safety you'll ever see. All right, let's bring it all home now. We've covered a ton of ground, so let's tie it all together. Because second-level thinking isn't just one clever trick. It's a complete philosophy, a whole new way of seeing the market. So if you're going to remember anything from our talk today, make it these points. First, always know where we are in the cycle. Second, be humble. Know what you don't know, and don't pretend you can predict the future. Third, always insist on a margin of safety. Never pay full price. Fourth, manage your risk before it manages you. Fifth, be a patient opportunist. Wait for that perfect pitch right down the middle. And finally, never forget, it's a loser's game. Play good defense, you bake these ideas into your process, and you'll have a strategy that can last a lifetime. I love this quote from Peter Bernstein because it's such a reality check. The market does not care about your retirement goals. It doesn't care that you need to make 8% this year. It's an impersonal machine. It's going to do what it's going to do. Our job isn't to tell the market what we want. It's to look at what the market is actually giving us and act rationally.
So I'll leave you with this one last question to chew on, a really crucial one. Are you playing an offensive game or a defensive one? Are you investing to win or are you investing not to lose? It might sound like the same thing, but believe me, it's a world of difference. Are you out there swinging for the fences, chasing every hot tip, or are you focused on not striking out, on making sure you live to play another inning? How you answer that question, well, it's probably going to define your entire investing journey.
You know, when you really look at the greatest investors out there, what's the one thing that truly sets them apart? It's not some secret algorithm, it's not a faster internet connection, it's something much deeper. It's a way of thinking. They call it second-level thinking, and today we're going to break down exactly what that means and why it is so absolutely critical. Let's dive in. I want to start with this quote from the legend himself, Charlie Munger. "It's not supposed to be easy. Anyone who finds it easy is stupid." You gotta love the honesty, right? And he's not just being clever here, he's laying down a fundamental truth. Investing is hard. If you're looking for a simple, plug-and-play formula, you are already lost. The real edge, the real alpha, comes from the rigorous thinking that happens long before you ever click buy. All right, so section 1 is the investor's dilemma. And this really gets to the heart of it. Why is achieving average returns so ridiculously easy, while superior returns feel almost impossible to grasp? I think this is where a lot of people trip up. We all want investing to be a science, right? We want a clean formula. If X happens, then Y will happen. But the reality is, it's much more like art. It's messy, it's emotional, and it's driven by the wild, unpredictable psychology of millions of people. There's no magic rule that works forever, because the second it does, everyone figures it out and the edge disappears. So you've basically got two paths you can go down. Path number 1 is the easy route. You can just buy an index fund, put in almost zero effort, and you're pretty much guaranteed to match the market's average returns. And let me be clear, there is absolutely nothing wrong with that. But if you're aiming for path number 2, if you want superior returns, well, you're going to need a little something extra. You either need incredible luck or you need superior insight. And since you can't exactly bottle luck, insight is really the only thing you can control. So this begs the question, and it's a huge one. In a world where everyone has the same news feeds, the same data, the same access to information, a world where millions of really, really smart people are all trying to do the same thing, who actually wins? How can anyone possibly have an edge? And the answer is, it's not about working longer hours or having a more expensive computer. It's about thinking better. It's about being more perceptive. It's about looking at the exact same painting as everyone else, but seeing the details and the patterns that they completely miss. Okay, so that leads us right into the core idea here. Section 2, 2 levels of thinking. This is where we start to really dig into the crucial difference between that common, superficial analysis and something much, much deeper. Let's look at a classic example. The first level thinker, their thought process is very simple, very linear. They see a good company and think, hey, that's a good company. I should buy the stock. Done. But the second level thinker, their brain immediately kicks into another gear. They think, okay, yes, it's a good company, but everybody knows it's a good company, and that means all that good news is already reflected in the stock price. It's probably overhyped and way too expensive. Maybe the right move is to sell. See the difference? Here's another one, and this is where it gets really interesting. Imagine the market is in a full-blown panic. The headlines are screaming about recession and inflation. The first-level thinker's reaction is pure emotion. This is terrible. Sell everything now. The second-level thinker sees that exact same terrible outlook, but comes to the complete opposite conclusion. They're thinking, yeah, the outlook is garbage, but because of that, the first-level thinkers are dumping everything in a blind panic. This is my chance to buy great companies on sale. Now, this last one is a bit more subtle, but it's maybe the most powerful. It's not just about what's going to happen, it's about what's going to happen relative to expectations. The first-level thinker says, I think their earnings will drop, so I'm selling. Simple enough. But the second-level thinker says, you know what? I also think earnings will fall, but the market is expecting an absolute catastrophe. I think they'll only fall a little bit, and that tiny bit of less bad news will be seen as a huge win, and the stock will probably jump, so I'm buying. It's a whole different ballgame. And this quote from investor Joel Greenblatt just nails it. This kind of first-level thinking is everywhere. It's the default setting. You see a headline on the news, and bam, that becomes your investment thesis. It's easy, it's conventional, and it is a one-way ticket to average results. Okay, so we get it, but how do we actually do it? Let's move on to section 3, inside the second-level mind, and talk about how to actually move beyond those obvious first-level conclusions. So here's the real question. How do you put this into practice? It's one thing to talk about it as a cool concept, but what does it actually look like when you're trying to make a decision? What's the process?
Well, here's a mental checklist. This is the toolkit. A second-level thinker doesn't just ask, what's going to happen? They ask, what's the full range of possible outcomes? They ask, what's the actual probability that I'm right? They force themselves to define the consensus view. What does everybody else think? And then, how is my view different? They try to figure out if the price already reflects too much optimism or pessimism. And finally, the big one. What happens if the crowd is right and I'm wrong? And what happens if I'm right and they're wrong? You have to think through all of it.
And yeah, looking at that checklist, one thing becomes crystal clear. The difference in the mental workload here is absolutely massive. This isn't a gut feeling. This is deep, difficult, analytical work. And frankly, that's why so few people actually do it.
So let's just put a fine point on it. First-level thinking is simplistic. It's superficial. It's what everybody can do. And precisely because everyone can do it, it can never, by definition, lead to superior results.
Second-level thinking, on the other hand, is deep. It's complex. Sometimes it's downright convoluted. It demands that you see things other people miss, that you have an insight they don't. It's hard. There's no way around it. But it's also where the real edge lies. Which brings us to our next part, section 4, the unconventional edge. This is all about the simple truth that if you want different results, you've got to start with different thinking. Okay, this image right here might be the most important part of this whole explainer. Look at that left column. If your behavior is conventional, meaning you do what everyone else is doing, you are guaranteed to get conventional or average results. Period. The only way to even have a shot at above-average results is to be unconventional, to be in that right-hand column. But here's the kick in the teeth. If you're unconventional and you're wrong, you get results that are worse than average. The goal, the holy grail, is that top right box, unconventional behavior backed by superior judgment. You have to be different and you have to be right. And this isn't just some cute idea I came up with. This concept is so fundamental that Paul Johnson once wrote that the wisdom in this section alone is worth the price of the entire book it came from. It's that important. So if we boil it all down, it comes to this. To win, you have to hold a view that is different from the crowd's view, and your view has to be more accurate. It sounds so simple, but it is unbelievably difficult to do in practice, year after year. And that leads us to our final section, section 5, your path to superiority. And we're going to end with a final challenge for you. But first, the good news. The fact that this is all so hard is actually what creates the opportunity in the first place. The market is full of first-level thinkers making emotional, superficial decisions. And their mistakes, their panic selling and their greed-fueled buying are what create the mispricings that a second-level thinker can exploit. Their herd behavior is your potential edge. So we'll leave you with this final thought. To outperform the average, you have to outthink the consensus. The question isn't for me to answer, it's for you. Are you capable of doing that? And if your answer is yes, what makes you think so? What's your real edge? Being brutally honest with yourself when answering that question, well, that's the true first step on the path to becoming a second-level thinker. Thanks for joining me.
All right, let's dive in. Today, we are going to tackle one of the most powerful and honestly one of the most controversial ideas in all of finance, the efficient market hypothesis. Now, this isn't just some dusty old theory. It's an idea that has shaped how literally trillions of dollars are invested. So understanding what it gets right, and maybe more importantly, what it gets wrong, is absolutely crucial if you're serious about investing.
So here's how we're going to break it all down. First, we're going to look at the theory itself in all its elegant academic perfection. Then we're going to start poking holes in it, looking at the cracks that show up when this perfect theory meets the messy real world. After that, we'll see how those cracks actually create opportunities for savvy investors. And finally, we'll wrap it all up with a smarter, more practical way for you to think about investing.
You know, this quote from the great Yogi Berra just says it all, doesn't it? This is exactly the ground we're going to cover today. We're going to navigate that fascinating and sometimes very profitable gap that exists between a beautiful theory on a chalkboard and the chaotic reality of how markets actually behave.
Okay, so let's set the scene. Our story really kicks off back in the 1960s at the University of Chicago. This was the birthplace of what's known as the Chicago School of Finance. It was a total revolution, bringing hardcore math and data to the world of investing. But out of all the big ideas that came from that time, one stood head and shoulders above the rest. And that big idea was the efficient market hypothesis, or EMH for short. So what is it really? Well, at its heart, it's a simple but incredibly profound statement. It says that at any given moment, the price of a stock, or a bond, or pretty much any asset you can think of, has already absorbed every last piece of public information about it. All the good news, all the bad news, all the whispers and rumors, it's all already baked right into the price.
So for this theory to work, you have to imagine a world that's just full of super smart, totally rational investors. They all have the exact same information, and they're all working around the clock to find some kind of an edge. And because of all that intense competition, any new piece of information, say an earnings report, gets reflected in the price instantly. The logical conclusion? There are no bargains left. Everything is always priced fairly. And the only way you can hope to get a higher return is by taking on more risk. There's no such thing as a free lunch.
Now, this line of thinking had massive real-world consequences. I mean, think about it. If you really truly believe that the market can't be beaten, then why on earth would you pay some fund manager a huge fee to try to beat it? It's a waste of money. And that exact logic led directly to one of the biggest financial innovations of our time, the low-cost index fund. It doesn't even try to be clever. It just aims to match the market and do it as cheaply as possible.
Okay, so that's the theory. It's clean, it makes sense, it's elegant. But, as Yogi Berra reminded us, practice is a whole different ballgame. So let's start looking for the cracks in this perfect theory. And a good place to start is by asking what that word efficient really means in the real world. And this, right here, is such a critical distinction. The academic theory kind of implies that efficient means the price is right, that it's a correct, accurate measure of a company's true, intrinsic value. But in practice, efficient really just means speedy. The market is incredibly fast at taking the consensus opinion and pricing it in. But that leads to a really important question. Can the collective wisdom of the crowd, all those smart, hardworking investors, can they be completely, utterly, spectacularly wrong? Well, let's just say history has a pretty clear answer to that one.
Let's hop in the time machine and go back to the absolute peak of the dot-com bubble. It's January of 2000. The market consensus, the collective wisdom, was that one single share of Yahoo stock was worth $237. This price supposedly reflected all the available information, and millions of very smart people agreed it was a fair price to pay.
Okay, now let's fast forward just a little over a year, to April of 2001. Now, the market consensus was that the exact same share of Yahoo stock was worth $11. So you have to ask yourself, how could the market be right on both of those days? It just can't be. The consensus was clearly dramatically wrong on at least one of those dates, and let's be honest, probably on both.
And that brings us to the absolute heart of what it takes to be a successful active investor. If you just follow the crowd, if you just believe the consensus, you're only ever going to get an average return. To do better, you have to do something different. You need what our source material calls second-level thinking. It's not enough to just have an opinion that's different from the crowd. You also have to be right.
You know, the theory's most fragile assumption, the real weak link, is the idea that investors are objective. I mean, are we really just cold, calculating machines? Of course not. We're human beings driven by powerful emotions like greed when stocks are soaring and fear when they're crashing. Objectivity goes right out the window. And the theory also assumes everybody can buy or sell anything they want. But in reality, most of us work in specialized areas, and very few people are comfortable betting against stocks. The real world is just so much messier than the neat and tidy theory. So if we agree the market isn't perfectly efficient, and we know that human emotions and real-world limits create mistakes, well, that means there must be opportunities out there. But where do you even begin to look for them? Well, funnily enough, the theory itself kind of gives us a roadmap. A market is most likely to be efficient and therefore really, really hard to beat when it has these characteristics. When it's super well known and everybody's watching it. Think about the big stocks, the ones in the S&P 500. There are thousands of brilliant analysts looking at them every single second of the day.
It's incredibly difficult to find an edge there. So if you want to find the real bargains, you just flip that whole list on its head. You look where other people aren't looking. You look at assets that are obscure or maybe even controversial. You dig into situations that are so complex that they scare other investors away. This is where mispricings, the raw material you need for superior returns, are most likely to be hiding.
But let's be clear, finding an inefficient market isn't some kind of golden ticket to riches. All it means is that you've sat down at a game of skill, not a game of pure chance. And this brilliant poker analogy just says it all. In an inefficient market, there are going to be winners and there are going to be losers. And it's all based on skill, discipline, and insight. It gives you the opportunity to win, but it also guarantees that someone else has to lose. Your job is to sit at that table and make damn sure you're not the fish.
All right, let's pull all of this together into a practical way to move forward. We know the pure theory isn't quite right, but we also know we can't just toss it in the garbage. So how do we balance these two powerful ideas to actually become smarter investors?
I think the best approach comes from the legal world, and it's this: treat market efficiency as a rebuttable presumption. So what on earth does that mean? Well, it means your default setting, your starting assumption for any investment, should be that the market price is fair and it's correct, unless you can find powerful, specific, compelling evidence to prove that it's wrong in this one particular case.
And to rebut that presumption, to prove the market wrong, you have to be a detective. Before you pull the trigger on an investment, you have to ask yourself these really hard questions. Why does this supposed bargain even exist in the first place? Why is the person who owns it now so willing to sell it to me? Do I really, honestly, know more than they do? Answering these questions is the only way to know if you've found a genuine insight or if you're just fooling yourself.
So, where does all this leave us? Do we just take decades of brilliant academic work and throw it out the window? Should we just rely on our gut feelings? Well, not at all. Ignoring the theory can lead you to make some really big, foolish mistakes, but swallowing it whole, without question, can be just as dangerous.
There's a classic story that I think sums up this whole balancing act just perfectly. There's a finance professor, a true believer in efficient markets, and he's walking across campus with one of his students. Suddenly, the student stops and points. "Hey, professor," he says, "isn't that a $10 bill lying on the ground?"
The professor, he doesn't even bother to look down. He just shakes his head and says, completely seriously, "No, it can't possibly be a $10 bill. If it were, the market would be efficient, and someone would have already picked it up by now."
So the professor, completely confident in his beautiful theory, just keeps walking. And the student, who is a little more grounded in reality, leans over, picks up the $10, and goes and buys himself a nice cold beer. And that really is the ultimate lesson here. Theory is a fantastic guide. It's an essential tool, but it should never, ever be allowed to overrule common sense. Because every now and then, the real world leaves a $10 bill lying right there on the sidewalk, just waiting for someone who's willing to look down and pick it up.
You've heard it a million times, right? The golden rule of investing. Buy low and sell high. But what if I told you the single most important thing isn't just about the price? It's about the value you get. In this explainer, we're going to pull back the curtain on the one concept that really separates the pros from the speculators. So, let's talk about value. Okay, let's just jump right in with that old saying, buy low, sell high. Sounds simple enough, doesn't it? But what does low actually mean? And what's high? Without some kind of yardstick, some objective measure, that phrase is basically useless for making a real decision today about a sale that might be years away. Well, the answer, the only thing that gives you a real yardstick, is this idea called intrinsic value. Think of it as the true underlying worth of something, completely separate from its wild, fluctuating price on any given day. For any serious investor, figuring out this value is ground zero. It's the absolute starting point. Without it, let's be honest, you're not really investing. You're just gambling. And look, this isn't just some obscure idea from a textbook. The great investor Joel Greenblatt points out that Warren Buffett himself says a good investment course only needs to teach you two things. First, how to figure out what something is worth. And second, how to think about the crazy price swings in the market. It all starts with that first part, understanding value. And this, right here, brings us to a huge fork in the road. It's a choice that every single person in the market has to make, whether they even realize it or not. There are two fundamentally different ways to approach this game. Okay, so on the one hand, you've got the analyst. This person is like a detective looking past the stock price to the actual business behind it, its earnings, its assets, its management team. They're analyzing the fundamentals. On the other hand, you have the trend follower. This person completely ignores the business and instead just stares at the squiggly lines on a price chart, basically trying to guess which way the line will squiggle next.
Now, let's just quickly talk about that second path. This is the world of technical analysis, chart patterns and momentum investing, which is just a fancy way of saying buy what's already going up. Now, this whole approach, it flies right in the face of what a lot of smart people in academia call the random walk hypothesis. And that's just a fancy way of saying that trying to predict a stock's next move based on its last move, well, it's like trying to predict a coin flip. Good luck with that.
This gets right to the heart of the problem for anyone who's just chasing momentum. The economist Herb Stein put it perfectly with this brilliant little line, a trend that's going up and up and up. Eventually, it's going to stop. So, what's your plan when the music stops? How do you know to get out before everyone else does? Want to see this in action? Just look back at the day trader mania in the late 90s. The trader buys a stock at $10, it goes to $11, they sell, and they pocket a buck. Feels great, right? They feel like a genius. They do it again later for another $1. But look at what's really happening here. While they were busy collecting their $3 little in profit, the underlying stock's value grew by $30. They were so busy picking up pennies that they completely missed the mountain of dollars right behind them. So you see, if you focus on the business itself, not just the jittery price chart, you sidestep that whole trap. That's why real intelligent analysis only happens on that first path. But even on that path, there's another split. Two great schools of thought that people often get really confused about. People always talk about this big fight, value investing versus growth investing. But honestly, that's kind of the wrong way to look at it. Think of it this way. A value investor wants to buy $1 worth of a business for, say, 80 cents. They're focused on the solid value they can get today. The growth investor, they might be willing to pay $2 for that same business because they're betting it's going to be worth $10 tomorrow. One is a bet on today's reality. The other is a bet on a forecast of the future.
So, what actually makes a company valuable at the end of the day? You can look at all these things, the cash on its books, the smart CEO, the fancy patents, the cool brand name. But here's the secret. All of those things, they're just ingredients in a recipe. The only thing that truly matters, the thing that all of it has to lead to, is the final dish, cash. Cold, hard cash flowing into the business for its owners over the long run. That's it.
Okay, let's talk about a classic cautionary tale. We're going to rewind to the late 60s and early 70s to see what happens when you get obsessed with value tomorrow and you completely forget about the price you're paying today. So back then, there was this group of stocks called the Nifty 50. These were the superstars, the IBMs, the Xeroxes, the Kodaks. They were considered absolutely invincible. And the thinking on Wall Street was, these companies are so great, it doesn't matter what price you pay. Well, it turns out price always matters. When the market crashed, these supposedly can't-miss stocks got hammered. And for many investors, it took decades just to get their money back. And the lesson here is huge. It's not just that overpaying for a great company can wreck your returns. It's that the invincible company of today can easily be tomorrow's dinosaur. All right, so this brings us to the final boss battle of investing. And it's not about math or spreadsheets. It's about your own mind. Because knowing what a stock is worth is one thing, but actually having the guts to act on that knowledge, especially when things get scary, that's a whole different game. So let me ask you this. Put yourself in this exact situation. You've done your homework, you are convinced a stock is worth $80, you get to buy it for $60, a great deal, you pull the trigger, and then it drops to $50. What do? I mean, really, how are you feeling in that moment? Be honest, your gut is probably screaming, panic. I made a huge mistake. But it's so weird, right? If your favorite brand of coffee goes on sale, you don't run away from it. You get excited and you buy more. But when a stock you liked at $60 goes on sale for $50, our brains just short circuit. Fear completely takes over and we want to run for the hills. The great investor Howard Marks really nails it here. What's really going on in that moment of panic? It's the deep primal fear of looking like an idiot. Being right about the value of a company doesn't mean the market's going to agree with you tomorrow. In fact, it means you're probably going to look and feel wrong for a while. There's that old saying, being too far ahead of your time is indistinguishable from being wrong. And that's the thing. When you're standing there holding that stock at $50 or maybe even $40, the entire world, every single tick of the market, is screaming in your face that you've got it wrong. It takes an iron will to tune all that noise out and trust your homework. So if you want to actually profit in a situation like that, you need 3 things. Think of it like a recipe. Number 1, your initial analysis of that intrinsic value has to be solid. Number 2, you need the stomach, the conviction to stick with it, and maybe even buy more as the price falls. But then there's a third ingredient, the one that everything else depends on. You actually have to be right in the first place. And this last quote from Joel Greenblatt just ties it all together perfectly. He says, look, if you do a good job, you do the work and value a stock correctly, the market will eventually agree with you. He guarantees it. The only catch is, he has no idea when that will happen. And that when, that waiting period, that's where the real test of an investor lies. So that really leaves us with the final question. And it has nothing to do with finance or economics. The question is about you. It's about your own character. Do you have what it takes to do the work, to form a conviction, and then stand there, all alone, while the world tells you you're wrong, just waiting for the day it finally proves you right? You know, when it comes to investing, there's really one concept that stands above everything else. If you can truly master this one thing, you're ahead of the game. So today, we're going to dig into the wisdom of the great Howard Marks and really break down the relationship between the price you pay for something and the value you actually get. All right, let's kick things off with this huge idea, because it's what separates the pros from the amateurs. I mean, think about it. It's actually not that hard to spot a good thing. You know, a great company, a famous brand, profits are going through the roof. But the real skill, the thing that actually makes you money over the long haul, is knowing how to buy it well. And that means waiting for that great thing to be on sale. So here's our game plan. We're going to start with the one golden rule you have to know. Then we'll get into the hidden forces that are really pulling the strings on prices. After that, we'll look at the trap of chasing whatever's popular. And finally, we'll land on the single most dependable strategy for long-term success. All right, let's dive right in. This first point is so important, yet it's where so many people trip up, and they might not even realize it for their entire investing lives. It's the difference between a good company and a good investment. You have got to separate these two ideas in your head. A company can be an absolute giant, innovative, profitable, best in the world. But if the stock price already reflects that and then some, it can be a terrible investment. You can pay way too much and lose a ton of money. On the flip side, some boring, overlooked company that nobody's talking about can be a fantastic investment if you can buy it cheap enough. They are two totally different things. And this right here just cuts through all the noise because it's just basic common sense, right? You would never ever agree to buy a car without asking the price first. Of course not. So why on earth do people do that with stocks? When everyone's excited and the market's going up, this simple, basic discipline just gets thrown right out the window. So here's the bottom line. The potential of anything you buy, a stock, a house, anything, is completely tied to the price you pay. Price is everything. It's the anchor. A high price can turn a brilliant company into a money-losing disaster, and a low price can make a mediocre company a huge winner. It all starts with the price. Okay. So if price is so important, what actually drives it? Let's get into that because it's not nearly as simple as most people think, especially in the short run. So think of a stock's price like this. It's a mix of 3 things. First, you've got the fundamentals, the company's actual worth, its earnings, that kind of stuff. But then you pour in 2 other ingredients that are way more unpredictable. Psychology, the greed and fear of the crowd, and technicals, which are basically the mechanics of the market itself. And in the short term, those last 2 can completely overwhelm the fundamentals. So what are technicals? It sounds kind of jargony, but it's a really powerful idea you need to get. These are basically forces that make people buy or sell for reasons that have nothing to do with whether the company's any good. It's the plumbing of the market forcing things to happen. I mean, just picture this. An investor who's borrowed a ton of money gets a margin call. The market went against them. They have to sell right now. They're not thinking about value. They're just trying to avoid getting wiped out. That's a forced seller. Or on the other side, a giant mutual fund gets $1 billion of new cash. That manager has to buy stocks with it, even if he thinks the market is way too high. These things create dislocations and opportunities. And that right there shows you the terrifying other side of the coin. If buying from a forced seller is a golden opportunity, being one is an absolute nightmare.
That's why the most important thing you can do is arrange your finances and your emotions so that you are never in a position where you are forced to sell. That's rule number 1. And that brings us to the other hidden force. And honestly, this one's even bigger: psychology. The collective mood of the market. When everyone's greedy and euphoric, or when everyone's terrified and panicked. That emotion can make prices do things that seem completely insane. The hardest battle in investing is controlling your own emotions. Okay, so what happens when all that psychology just goes completely off the rails? Well, that's when investing stops being about business and starts becoming this dangerous popularity contest where price has nothing to do with reality anymore. You know, when something is at its absolute peak of popularity, think about what that means. Every bit of good news is already known. Everyone who loves it already owns it. There's nobody left to buy. So from that point, where can the price really go? The only thing that can happen is for some of those people to get disappointed and decide to sell. Let's look at a perfect cautionary tale from history. Back in the late 60s and early 70s, there was this group of stocks called the Nifty 50. These were the absolute best, can't-lose companies in America. Think Xerox, IBM, Coke. The idea was you could buy them at any price because they were just that good. So get this, at their peak, these amazing, world-beating companies were trading at PE ratios of 80 to 90. Now, just for context, the historical average for the market is around 15. So people were paying a price that assumed these companies could do no wrong ever. They were literally priced for perfection. But here's the thing. Perfection never lasts. When the mood changed and a nasty bear market hit in the early 70s, these same stocks got crushed. Their PE ratios fell from 90 all the way down to 8 or 9. People who bought the best companies in America at the top lost 90% of their money. The companies were still great, but the price they paid was a catastrophe. And you see this same pattern play out again and again. Every bubble starts with a great story that's usually true. Then early investors make a bunch of money, which gets everyone else excited. Pretty soon the fear of missing out, FOMO, just takes over. And eventually it just becomes the greater fool's theory. People know the price is insane, but they buy anyway, hoping they can sell it to someone even more foolish down the road. So these are the lessons you have to burn into your brain to protect yourself. Remember, just because a price is high doesn't mean it can't go higher. Trying to time the exact top is impossible. But, and this is the key, eventually, that anchor of reality has to matter. Eventually, valuation has to win. Gravity always works. All right, so if chasing what's popular is basically a recipe for disaster, what's the right way to do it? What is the most reliable, most dependable way to actually win at this game in the long run? You know, when you really boil it all down, there are only a handful of ways to actually make money investing. You can hope the company does well, but that's hard to predict. You can use leverage, but that's just playing with fire. You can try to sell to a bigger fool, but that's not a strategy, that's gambling. That leaves just one route that is truly dependable. And this is the whole key right here. The most dependable strategy is buying something for less than it's really worth. And this is why it works. Value acts like a magnet for price. It might take a while, but eventually the price gets pulled toward what the asset is actually worth. You don't need luck. You just need reality to set in. But, and trust me, this is a huge but, you have to be patient. That magnetic pull doesn't always work overnight. As the old saying goes, the market can stay crazy longer than you can stay in the game. You have to have the financial and emotional strength to hold on while everyone else is telling you you're wrong until that magnet finally does its job. And really, that's what this all boils down to, isn't it? The strategy itself is dead simple. Buy things for less than they're worth. Anyone can understand that. But actually doing it, resisting the crowd, controlling your own fear and greed, being patient, man, that's hard. That's the work of a lifetime. The real battle isn't with the market, it's with yourself.
Welcome to The Explainer. Today, we're going to tackle what is, without a doubt, the single most important and probably the most dangerously misunderstood concept in all of investing, and that's risk. Look, it's something we all have to face, because at its very heart, investing is all about trying to navigate a future that we just can't predict. So let's figure out how to do it wisely.
So, here's what we're going to do. First, we are going to completely dismantle a very common and, frankly, very dangerous myth about risk. And then from there, we'll build up a much smarter, more practical way to think about what is really at stake every time you put your hard-earned capital to work.
All right, let's dive right in. We're going to start with a graph that I bet you've seen a million times. Whether it's in a finance textbook or a presentation from a financial advisor, it's an image that has really shaped how millions of people think about investing. And honestly, not for the better.
So this thing is called the capital market line, and it's basically a cornerstone of modern financial theory. And you can see why it's so popular, right? It looks so clean, so simple, just sloping neatly upward. The message it sends is totally unmistakable. The more risk you take on, the more return you should expect to get. It makes investing look like a simple, predictable trade-off.
And that graph leads directly to this kind of thinking, especially when the markets are hot and everything's going up. It starts to feel like a law of physics, you know? An easy formula for success. But this massive oversimplification is a trap, and it's a trap that has gotten countless investors into some serious trouble over the years.
And this, right here, is the crucial point. Just think about it for a second. If you were guaranteed to get a higher return for taking on more risk, where's the risk? It wouldn't exist. That simple, elegant line is hiding a much more complicated and uncertain reality.
So if that neat straight line is basically a lie, what does the truth look like? Well, let's try to build a more honest picture of the relationship between risk and return, one that actually respects the uncertainty that we all have to deal with.
Okay, now check this out. The contrast on this slide is everything. On the left, you've got that deceptive, simple line we just talked about. But on the right, now that is a much more helpful picture. You see the straight line is still there. That represents the expected return. But now you have these bell curves that show the whole range of possible outcomes. And notice what happens as you move to the right, as you take on more risk. That range of possibilities gets wider and wider and wider.
And this illustrates the real deal perfectly. Riskier doesn't mean you will get higher returns. It just means you have the prospect of higher returns, which is what entices you to invest in the first place. But what it also means is you have a much wider distribution of outcomes, which absolutely includes the very real possibility of lower returns, or even worse, painful permanent losses. Risk isn't a guarantee of reward, it's a guarantee of less certainty.
So this gets us right to the core of the problem. We've been using a totally flawed definition of risk this whole time. And if we want to invest intelligently, we have to start by redefining the enemy that we're actually up against.
You see, in the world of academic finance, risk gets defined as volatility, basically how much an asset's price bounces around. And why do they do that? Well, honestly, it's convenient. Volatility is a number. You can calculate it, you can plug it into a formula. But for a real person, someone saving for retirement or for their kids' college education, the day-to-day ups and downs are not the real enemy. The true danger is something way more fundamental.
And that, right there, is the definition that truly matters. This is the risk that keeps real investors up at night. It's not that your portfolio might be down next quarter. It's the terrifying thought that the capital you invested is just gone, for good. The real peril isn't the fluctuation of the price. It's the chance you'll never get your money back.
Now, beyond that ultimate risk, that fear of permanent loss, risk is actually pretty sneaky. It wears a lot of different disguises. And it's really important to recognize these because they're often deeply personal and subjective.
You know this feeling, right? For a lot of investors, both professional and individual, the psychological pain of lagging the market, say the S&P 500, can be absolutely immense. And that fear, that feeling of being left behind, can cause people to chase hot trends and abandon a really disciplined, sound, long-term strategy right at the worst possible moment.
Oh, this one is a classic conflict of interest. A fund manager might see a truly brilliant but maybe unconventional investment, but they pass on it. Not because it's bad for their client, but because if it goes wrong, they'll look foolish and they could lose their job. For their career, it's much safer to just kind of hug an index and get average results than it is to take a bold step that could lead to truly superior returns.
And this is a perfect example of how subjective risk is. Just imagine a private, illiquid investment, something you can't sell easily. For a giant pension fund with a 30-year time horizon, that might be a perfectly safe, even desirable asset. But for you, if you need that money for a down payment in 6 months, that exact same asset is incredibly risky because you might not be able to sell it when you need the cash.
So all of this leads to a really profound insight. If risk means different things to different people, and if it's all about a future that we can't possibly know, then you can't really measure it. You can't boil it down to a single objective number. At the end of the day, risk is an opinion.
Let me ask you a question. Let's say you buy a stock for $100, and a year later, you sell it for $200. Great outcome, right? But was the investment safe? The truth is, the outcome alone tells you absolutely nothing about the dangers you were exposed to along the way.
We only get to live in one reality, the one where your investment worked out. But there were countless other potential futures, what some people call alternative histories, where things went horribly, horribly wrong. That successful outcome you experienced might have just been one lucky roll of the dice out of 100 possibilities, and many of those other possibilities were deeply unpleasant.
And this is the real danger. In a roaring bull market, the person who takes the most insane risks often gets the best results, at least for a while. We might call them a genius, but they may just be what the author Nassim Taleb famously calls a lucky idiot, someone who took a wild gamble that just happened to pay off this time. And without understanding the risks that were actually taken, it's almost impossible to tell the difference between luck and skill.
Okay, so if risk is this subjective, unquantifiable phantom that only exists in the future, how on earth are we supposed to deal with it as investors? How can we possibly make good decisions?
This quote from Elroy Dimson, I think this is one of the most powerful and brilliant summaries of investing ever written. The future isn't a single point that's destined to happen. It's a huge range of possibilities. We only get to see one outcome play out, but that doesn't mean the others weren't possible. A great investor never ever forgets that.
All right, let's bring this all together into a new, smarter framework. The first, most crucial shift is to just stop defining risk as volatility. Start focusing on what truly matters, the potential for the permanent loss of your money. From there, you have to accept that risk is a subjective opinion, not some hard number you can find on a spreadsheet. And that leads to the final pillar of wisdom, embracing the fact that our job as investors is to make intelligent decisions in the face of a future we can never, ever truly know.
So why is this so hard for us? Well, our brains are kind of wired to miss true risk. We anchor all our expectations on a past that feels certain and predictable, and we totally underestimate how much things can change. We make these worst-case projections that are usually just the worst thing that's happened recently, failing to imagine something truly unprecedented. And because risk often shows up suddenly, in these concentrated bursts, it's way too easy to get complacent during the calm periods between the storms.
And this brings us to our final and I think most important thought. If risk can't be measured and the future is a total unknown, where does a skillful investor find their edge? I mean, it might sound hopeless, but it's not. The answer is that humbly acknowledging this profound uncertainty, that's not a sign of weakness. It's the absolute foundation of investing wisdom. In fact, it's the very first step on the path to becoming a truly great investor. Thanks for joining us on The Explainer.
All right, when I say investment risk, what pops into your head? Probably things like market crashes, recessions, scary headlines. And yeah, for most of us, that's it. But what if the biggest risks, the real dangers, aren't created when things are bad? What if they're actually born when everything feels amazing? During the absolute peak of a boom? It sounds kind of backwards, right? Well, that's exactly what we're going to dig into today. We're going to use the wisdom of legendary investor Howard Marks to completely flip the script on how we spot danger in the market. And, this quote right here from Andrew Crockett, it's the perfect way to kick things off because it gets to the heart of it all. Investing isn't just a spreadsheet. It's not a math problem. It's a human problem. The biggest wild card, the thing that can absolutely wreck even the best investment thesis, it's us. It's our own psychology. It's that little voice in our head telling us to get greedy or to panic. Okay, so here's the game plan. We're going to start with what risk really is. Then we'll talk about the investor's worst enemy. We'll look at how price, risk, and return are all connected, see what happens when safety gets dangerous, and finally, we'll wrap up with how to read the market's mood. Let's jump in. All right, section 1. Let's deconstruct what most people think they know about risk. So this quote, it just turns everything on its head, doesn't it? I mean, we all feel safest when the market's roaring, when everything's green. But what this is saying is, that's exactly when the danger is secretly piling up. It's like a financial fault line, right? During the sunny, calm days, that's when the pressure is building, silently, deep underground. The earthquake, the crash, the recession, that's not when the risk is created. That's just when it all breaks loose. The danger was there the whole time, building up during the good times. So, okay, if risk isn't just the crash itself, then what is it? Howard Marks gives us this really clear, practical definition. And this is so important. Risk isn't just the market bouncing around day to day. That's just volatility. No, real risk, that's the actual possibility of permanent loss. It's the chance you put your money in and you don't get it back. It's all about the uncertainty of the future, not the wiggles of the past.
All right, so we've established that risk is built up during the good times. But how? What's the actual trigger? Well, that leads us right to what Howard Marks calls the investor's #1 enemy. And there it is. It's almost disappointingly simple, isn't it? The greatest risk doesn't come from a bad company or a volatile asset. The #1 most guaranteed way to lose money is to simply pay too high a price. That's it. It doesn't matter how great the asset is. If you overpay, you've introduced massive risk. Price is everything. And this really shows two totally different mindsets. You've got the theorists, the academics, who often see risk and return as two separate things on a seesaw. You want more return, you got to take on more risk. But the value investor, they see it completely differently. To them, a high price does two terrible things at once. It cranks up your risk and it crushes your future return. They're not separate, they're two sides of the exact same coin. And that coin is the price you pay. Okay, so let's actually visualize this relationship between price, risk, and return. This is where you can see how psychology literally bends the shape of the market. So the basic idea here is something called the risk premium. It's simple, really. If you're going to take a risk on something, anything riskier than, say, a super safe government bond, you should expect to be paid for it, right? You should demand a higher potential return for taking that gamble. That extra potential payday, that's your risk premium. Totally logical. Now, this is what a healthy market looks like. This nice upward sloping line is called the capital market line. See, down in the bottom left, you've got super safe stuff. Think treasury bills, low risk, low return. But as you move up and to the right, you start taking on more risk. Corporate bonds, stocks, all the way to high risk venture capital. And for each step up in risk, you expect a step up in potential return. The line goes up. That's a market where people are thinking clearly and demanding to be paid for the risks they take. But watch what happens when greed and optimism take over. Look at this second line. This is a market that's lost its mind a little bit. Two things have happened. First, the whole line is lower. That means future returns for everything are just worse. But second, and this is the really dangerous part, the line is almost flat. That beautiful upward slope is gone. That means the risk premium we just talked about, it's basically vanished. People are so eager to buy, they're paying high prices for risky stuff without demanding any extra reward. The bottom line? You are taking on way more risk for way less potential payoff. And look, this isn't just some textbook theory. This is exactly what happened in the real world in the years just before the 2008 financial crisis. Let's dig into how the collective belief that risk had been eliminated became, ironically, the biggest risk of all. So back in the mid-2000s, the market was telling itself some amazing stories. We could even call them fairy tales. You know, the idea that central banks had figured out how to stop recessions forever, that globalization had spread risks so thin it basically disappeared, that all these fancy new financial products weren't just hiding risk, they were magically making it vanish. These were the stories that made everyone feel invincible. And this SUV analogy is just perfect. It's a real thing. Studies have shown that when people feel safer in a big, heavy SUV, they tend to drive a little crazier. They take more chances. And the exact same thing happens in finance. That feeling of being safe, that belief in all those fairy tales, it just encouraged everyone to take on more and more risk, which of course made the whole system way, way more dangerous. So what's the big lesson from that whole mess? It's that risk is like energy in physics. You can't actually destroy it. You can only move it around. All that fancy financial engineering back then, it didn't get rid of the risk. It just chopped it up into a million little pieces and hid it all over the global financial system, so nobody knew where the real danger was. And that, of course, made everything a whole lot riskier. Okay, so how do we personally avoid getting caught in that trap? What are the actual signs we can look for? What tells you that risk is high, even when everyone else feels great? Well, this final section is all about that. It's a practical checklist. Now, look closely at this list. What do you notice? None of this is about PE ratios or GDP forecasts. It's a checklist of human emotion. It's about psychology. And this is exactly what Howard Marks was seeing in the summer of 2007, right before the wheels came off. Fear was gone. Skepticism was gone. Everyone was eager to buy. Nobody wanted to sell. These are the red flags. It's not about the math. It's about the mood. And all of this leads to the ultimate irony in investing, a real paradox.
The very moment an investment gets popular and everyone piles in to grab it, their own actions, the act of buying and pushing the price up, actually destroys the very reward they were chasing in the first place. Howard Marks has a great name for this. He calls it the perversity of risk. And it really is perverse. Think about it. When everyone is panicking and selling everything, what are they doing? They're pushing prices down, which actually makes assets safer and creates amazing opportunities. And on the flip side, when everyone's euphoric and buying like crazy, they're pushing prices up and creating the risk that they're all ignoring. We're not just playing in the market. Our collective actions are making the market. So if you remember one thing, let it be this. Investment risk is hiding in plain sight. It's at its absolute highest where it is least perceived. And conversely, the best opportunities, the greatest safety, often lies in the places that look the scariest, where everyone else thinks the risk is off the charts. And I mean, who said it better than Warren Buffett, right? It's only when the tide goes out that you find out who's been swimming naked. During those easy, good times when the market is lifting all boats, it's easy to mistake luck for skill. But when things turn, that's when you see who is taking foolish risks all along. In the end, you just have to think of the market as a giant pendulum, always swinging back and forth. It swings from euphoria, where nobody sees any risk, to despair, where people see risk everywhere. Now, the trick isn't trying to predict the exact top or bottom of that swing. That's a fool's game. The real goal is to just have an honest assessment of where we are today. So with all that we've talked about, the psychology, the prices, the stories people are telling, I'll just leave you with this to think about. Where on that swing do you think we are right now?
You know, when we think about what separates the truly legendary investors from everybody else, what's the first thing that comes to mind? It's usually about hitting home runs, right? Finding that one stock that just explodes. But what if I told you that's not it at all? The real secret, the hidden superpower of the best in the business is something far less glamorous but way more powerful, controlling risk. And today, we're going to pull back the curtain on exactly what that means.
Okay, so let's really dive into this. If I asked you this question straight up, what would your gut answer be? I bet for 99% of people, it's about getting the absolute highest returns. We see the headlines, right? We hear the stories of people who made a fortune seemingly overnight. But what if that's the wrong way to look at it? What if we're all celebrating the wrong thing?
This quote from Christopher Davis just nails it. A lottery winner gets a mind-blowing return. But do we ever call them an investment genius? No way, of course not. We all instinctively get that their win was just pure, blind luck. It was the result of taking on an insane amount of risk, not some brilliant skill. And that difference, the one between a lucky outcome and a skillful process, is exactly what we're going to unpack today.
So here's our roadmap for this explainer. First, we're going to bust the great return myth. Then we'll shine a light on the invisible danger that is risk, and check out the two main paths to adding real value. After that, we'll get practical with a 4-step framework for taking smart risks, we'll expose the dangerous complacency trap, and we'll wrap up with a really critical distinction, the difference between controlling risk and just trying to avoid it.
All right, let's kick things off with the great return myth. Our entire culture is just obsessed with high returns. It's flashy, it's exciting, it makes for great stories. But focusing only on the big winners, the ones who get all the attention, means we're completely ignoring the other and, frankly, the more important side of the coin.
This right here, this is the whole ballgame. The true sign of a great investor isn't just about their offense, it's about their defense. What really sets them apart over the long haul is their relentless ability to manage the downside and sidestep those catastrophic losses. Think about it. Legends like Warren Buffett didn't build their fortunes on a few spectacular years. They built them on decades of steady, consistent, risk-controlled performance.
So, to really get why risk control is so critical, we have to first understand what risk actually is. And here's the key. In good times, you can't see it. It's totally invisible. Risk is this hidden, quiet force. It's only when everything goes wrong that its presence becomes, well, painfully obvious.
Think of it this way. Risk is just the potential for something bad to happen. It's not the bad thing itself. The source material uses a fantastic analogy here. It's like germs in the air. The germs are the risk. They're invisible, and as long as you're feeling healthy, you might not even know they're there.
Loss, on the other hand, is what happens when those germs actually make you sick. Loss is the thing you can see and feel. It's the market crash, the company going bust. Loss is what you get when that potential for things to go wrong, the risk, finally meets a negative event. Just because you didn't have a loss today doesn't mean there was zero risk yesterday.
And this is where that famous Warren Buffett quote comes in. I mean, it is the perfect metaphor. When the market is booming, when the tide is high, everyone looks like a genius. But you have no idea who built a solid, risk-controlled portfolio and who is just gambling and getting lucky. You only find out who's who when the tide goes out and the market turns south.
So, if managing risk is the key, how does that actually help your performance? Well, there are basically two ways an investor can add value, or what the pros call alpha. But as you're about to see, one of these paths is a lot more subtle, and in the end, it's far superior.
Okay, so this first path is the one everybody knows. You take on the same amount of risk as the market, but your skill allows you to generate a higher return. The extra return you got, that's the value added. And hey, that's a great outcome, no question about it. But it's only half the story. But now take a look at this. This is the superior path. Here you achieve the exact same return as the market, but, and this is the genius part, you do it by taking on fundamentally less risk. The value you've added isn't in a higher number on the screen, but in the risk reduction. And believe me, that is a much harder and more profound thing to pull off.
So which way is better? It's not even a contest. The second one is, by far. Focusing on cutting risk is what provides the foundation for real, lasting success. It means you're building a portfolio that can actually endure the tough times, one that still captures gains when markets are up, but is much better protected when they inevitably go down.
Okay, so how do we actually do this? How do we bear risk intelligently? The source gives us a fantastic model to follow by looking at one of the most conservative industries on the planet, life insurance. I mean, these guys are literally in the business of profiting from the ultimate certainty, death, by being masters of managing risk.
And their whole process breaks down into this simple four-step framework. First, they are deeply aware of the risk. They know everyone will eventually pass away. Second, they analyze it obsessively, using doctors and complex actuarial tables. Third, they diversify that risk by insuring millions of different people. And fourth, and this is absolutely key, they make darn sure they get paid to bear that risk by setting premiums at a profitable level. This is the exact same playbook a superior investor uses for their portfolio.
Now, this all sounds pretty straightforward, right? But it's incredibly hard to do in the real world because of a powerful psychological flaw we all have, the complacency trap. When times are good, year after year, our brains literally get rewired to believe the good times will last forever. We forget that the risk is still there, lurking just beneath the surface.
Nassim Nicholas Taleb just captures this perfectly. It's like playing Russian roulette, but with a gun that has thousands of chambers. After a few dozen clicks and nothing happens, you start to forget the bullet even exists. And that false sense of security, that's precisely when investors get sloppy. They relax their rules, they take on more debt, and they set themselves up for disaster.
And this diagram shows you exactly why that happens. We live almost all of our lives in the fat part of the bell curve, the normal, everyday, expected outcomes here at A, B, and C. So we base all our decisions on that reality. But we completely forget about the possibility of the extreme outliers, those rare but devastating events way out in the tails at D and E. We forget that black swans exist and that they can wipe you out in an instant.
So why does avoiding those big disasters matter so much? Let me just put a number up on the screen for you. -40%. Just look at that number for a second.
Because here's the brutal, unforgiving math of compounding. If your portfolio falls by 40%, you don't just need to make 40% back to recover. No, you need to make a 67% gain just to get back to where you started. This is why avoiding the big losses is mathematically way more important than capturing every last bit of upside. Like they say in sports, defense wins championships.
All right, this brings us to our final and maybe the most important distinction of all. We've been talking about risk control this whole time, but it is absolutely crucial to understand that risk control is not the same thing as risk avoidance. They're two totally different things.
This comparison lays it all out. Risk control is the path to avoiding losses. Risk avoidance is the path to avoiding returns. Sure, you could stuff all your cash under a mattress to avoid all risk, but you are guaranteed to gain absolutely nothing. The goal isn't to run away from risk, it's to develop what the source calls risk intelligence, to understand risks, manage them, and make sure you are well paid for taking them on.
So, let's sum it all up. The true mark of a superior investor is skillful risk control. Their success over a lifetime is defined less by the genius of their biggest winners and more by the disciplined avoidance of those major portfolio-crushing losers. It's a game of defense, it's a game of consistency, and it's a game of intelligent risk-taking.
And that leaves us with one final question for you to think about.
Take a really hard, honest look at your own investments. Have you truly identified and analyzed the risks you're taking? Or, with the market's tide being so high for so long, is it possible you're just swimming along not knowing for sure what you're wearing underneath?
All right, let's dive into what I believe is the single most important, most fundamental concept in all of investing, and that's being attentive to cycles. You know, there's very little we can actually be certain of in the markets, but the one thing you can absolutely count on is that almost everything is cyclical. Really getting this is the key to navigating the inevitable ups and downs that come with the territory. It all really starts with this one simple idea. Trees don't grow to the sky. Nothing goes in one direction forever. Markets don't, economies don't, and individual companies certainly don't. Now, this isn't about being a pessimist. It's about being a realist. And if you can just accept this one simple truth, you're already on the path to making much, much better investment decisions. So here's how we're going to break this down. First, we're going to establish the one unbreakable rule you need to have in your toolkit. Then we'll get into why these cycles are just an inevitable part of the game. After that, we'll do a deep dive into the most powerful cycle of them all, the credit cycle. Then we'll tackle the 4 most dangerous words in investing. And finally, we'll bring it all home and talk about how you can use this understanding to get a real edge. You know, in the world of investing, there really aren't many sure things. I mean, forecasts can be spectacularly wrong, and things that look like a sure bet can just fall apart. But in all that chaos, there are 2 concepts, 2 ideas that you can hold on to with total confidence. Okay, here's the first one. Most things will prove to be cyclical. It's that simple. Very, very few things in life or in markets move in a perfectly straight line. You're always going to see progress, and then you're going to see some deterioration. You'll see a period where things are going great, followed by a period where they're not going so great. It is the fundamental rhythm of pretty much everything. And that leads directly to the second concept, which is just as important. Some of the biggest losses in history have happened when people forget that first rule. But, and this is the key, that's also where the absolute greatest opportunities are born. It's when the crowd gets completely convinced that a trend is going to last forever, and you understand that it simply won't. So, the big question is why? Why does this happen over and over again? It's not some law of physics or anything like that, no. The real reason for the cyclical nature of our world is something far more messy and unpredictable. Us. The involvement of human beings. Think about it like this. A purely mechanical process, like a machine on an assembly line, moves forward in a straight, predictable way. It just runs and runs. But the second you introduce people into an equation, whether it's economics or markets or history, everything changes. We are emotional creatures. We're inconsistent. We're not these cold, calculating machines. We overreact to good news and we underreact to bad news, and vice versa. It's that human psychology that powers the massive swings of the cycle. So let's look at what actually happens at the top of a cycle, when optimism is just running wild. When everyone feels good about the future, their behavior changes in really predictable ways. We spend more and save less. We start borrowing money to try and juice our returns, which of course makes our whole financial position way more precarious. But hey, in the good times, who's thinking about risk? Risk becomes this abstract idea that everyone just kind of forgets about. And that behavior right there is what sets the stage for the inevitable reversal. And this gets to the beautiful, self-correcting nature of cycles. They don't need some big external event to make them turn. The trend itself creates the very conditions for its own reversal. You see, success and all that optimism, it leads to risky behavior. It plants the seeds for the next failure. And on the flip side, the despair and the extreme caution you see at the bottom of a cycle, well, that creates the perfect low-risk conditions for the next big success. Now, if you want the absolute best case study for this human-driven cycle, look no further than the credit cycle. It deserves its own special section because, honestly, it's just so powerful. It's inevitable, it's incredibly volatile, and it creates massive opportunities for investors who are paying attention. Okay, so the boom phase follows this classic repeating pattern. First, the economy is doing well. Lenders and investors are making good money, and they have more capital to put to work. Since there's not a lot of bad news, the fear of losing money just disappears. Risk aversion vanishes. And pretty soon all the lenders are competing with each other to lend more money. So they lower their rates and they ease up on their lending standards. This all leads to one of the most crucial ironies in finance. The absolute worst loans are always made at the best of times. And then, like clockwork, this cycle flips. those bad loans start to go sour, losses start piling up, and the lenders who were once feeling euphoric suddenly get really discouraged and fearful. Risk aversion comes roaring back, they slam the brakes on, tighten their standards, and suddenly capital becomes scarce. The companies that needed that debt to survive can't get it anymore, which leads to defaults and bankruptcies. This credit crunch starves the economy of capital and just makes the downturn that much worse.
And listen, this isn't just some abstract theory. This is a pattern that has repeated itself again and again and again. The late 80s real estate collapse, the mid-90s emerging markets crisis, long-term capital management in '98, the dot-com bust in 2000, and of course, the big one, the global financial crisis of 2008. In every single one of these cases, the boom was fueled by way too much cheap money, which led to overexpansion and then, eventually, a dramatic collapse. So, if this pattern is so obvious, why do smart people keep falling for it? Well, it all comes down to a very powerful psychological trap. It's a belief that pops up at the absolute peak of every single cycle, and it's captured in what are probably the 4 most dangerous words for any investor. This time, it's different. Let's look at late 1996. The tech bubble was just starting to inflate, and the Wall Street Journal wrote that a new consensus was emerging that the big, bad business cycle has been tamed. We all know how that story ended a few years later. But this is not a new thing at all. Let's wind the clock all the way back to January 1st, 1928, right on the eve of the Great Depression. The president of a major car company declared, "There will be no interruption of our present prosperity." Whoops. Later that same year, another prominent business leader proclaimed that they were only at the beginning of a golden age. I mean, the optimism was completely disconnected from this cyclical reality that was about to hit them like a freight train. And here's maybe the most famous example of them all. On October 25th, 1929, that's just 4 days before the crash that started the Great Depression, President Herbert Hoover himself insisted the fundamental business of the country is on a sound and prosperous basis. You see the pattern, right? Every time an upcycle goes on for a long, long time, people start to believe it's permanent. They'll point to some new technology or some new government policy as proof that the old rules just don't apply anymore. For anyone who's paid attention to history, that phrase, "this time it's different," should be a massive, flashing red flag. Okay, so we get it. Cycles exist, they're driven by human emotion, and people consistently fall into this trap of thinking they've been abolished. So what's the real question? The real question is, how do we turn this knowledge into a tangible advantage? How do we actually make this our edge? The key is to avoid the single most dangerous mistake that almost every investor makes at some point, and that is extrapolation. This is just the simple but deadly assumption that whatever's been happening recently is going to keep happening forever. And the absolute riskiest time to do this is when things are going great, when profits are up, markets are soaring, and money is cheap. That's when we trick ourselves into thinking that things will just improve indefinitely. So the crucial takeaway is this: you can't predict, but you absolutely can prepare. First, just accept that cycles are never, ever going away. Second, recognize that human emotion is what's in the driver's seat. Third, be incredibly skeptical when you hear that phrase, "this time it's different." And remember, your goal isn't to perfectly time the peak or the bottom. That's a fool's errand. Your job is simply to have a good sense of where you are in the cycle and prepare for its inevitable turn. And never, ever forget, the best time to get excited and optimistic is when the market is on its back and everyone else is panic selling. Ultimately, this is the mindset you're aiming for. You don't need a crystal ball. You just need an awareness of history, a healthy respect for psychology, and a commitment to preparing for a future that will, without a shadow of a doubt, be cyclical. So I'll leave you with one last question to chew on. It's just human nature that whatever trend we're in right now feels permanent. The highs feel like they're going to last forever, and the lows feel like they're never going to end. So given everything we've just talked about, I want you to take a moment and just ask yourself, where in the cycle do you think we are today?
All right, welcome. Today we are diving into a really powerful way of thinking, a mental model that helps make sense of the often wild, irrational world of investing. Honestly, once you really get this concept, it's going to fundamentally change how you look at every single market boom and bust. So let's jump right in.
You know, we have to start with this fundamental puzzle that trips up so many of us in the market. It really is the multi-trillion-dollar question, isn't it? Why is it that smart, rational people so often end up buying at the absolute peak and then panic selling at the very bottom? Why do we act directly against our own best interests time and time again?
You know what? The legendary investor Howard Marks just absolutely nails it with this quote. It perfectly captures that self-defeating cycle we see over and over. And this isn't some new thing. This is a deeply human pattern of behavior that shows up whenever we're faced with the emotion and the uncertainty of the markets.
But what if there was a way to actually understand this chaos, to see the pattern in all the madness? Well, there is, and probably the most elegant metaphor to explain it all is the idea of the pendulum.
So what Marx is getting at is this. Don't picture the market as some steady, rational line going up and to the right. Picture it as a pendulum in constant motion. And here's the key insight. That average or normal point in the middle, that's actually where the market spends the least amount of its time. It's pretty much always on the move, swinging from one emotional extreme to the other.
Now, this is what's so fascinating. Look at all the different ways this pendulum swings. It's not just about price, going from overpriced to underpriced. It's a huge psychological swing, from euphoria to depression. It's about going from celebrating only the good news to obsessing over every single negative headline. It's that swing between being credulous, where you'll believe any story that promises a quick buck, and being so skeptical you trust nothing. And maybe most importantly, it's the swing from a reckless tolerance for risk to a complete, paralyzing fear of it. Investor psychology is the engine driving this whole thing.
Okay, this is a really crucial point. Think of it like physics. The higher you pull a pendulum to one side, the more potential energy you're building up, right? That stored energy is exactly what guarantees a powerful and usually fast swing back in the other direction. The boom always contains the seeds of its own bust. And the bust creates the conditions for the next boom. They're two sides of the same coin.
All right, so let's zoom in on the most powerful swing of them all. This is the big one, the swing between the two primal emotions that really run the show, greed and fear. You could say this is the main axis that the entire market pendulum swings around.
And this chart just lays out the two psychological states perfectly. On the left, you've got the mindset of greed that takes over during a boom. We feel invincible, we're totally comfortable with risk, maybe even seek it out, and we're only focused on how much money we can make. Then on the right, you have the mindset of fear during a crash. It completely paralyzes us. We're terrified of a total meltdown, we only see the potential for more losses, and we become incredibly defensive.
So here's the kicker. It's not always that the underlying value of the companies or the assets changes so dramatically. What really, truly changes is our collective attitude, our willingness to take on risk. When we're feeling greedy, we'll pay almost any price for a risky asset. But when we're fearful, we wouldn't touch that same asset with a 10-foot pole, even if it's on a massive discount.
Every single investor, you, me, everyone, faces this constant trade-off. There's just no escaping it. On one hand, you've got the risk of losing your money. On the other, you've got the risk of missing out on a huge opportunity. A healthy, balanced market is aware of both. But at the extremes of the pendulum swing, we completely forget that balance. In a bubble, the only fear is missing out, FOMO. In a crash, the only fear is losing more money.
Okay, I know this can all sound a little bit theoretical, so let's make it real. Let's look at how this whole pendulum idea played out in one of the most dramatic market cycles any of us have ever lived through, the lead up to and the crash of 2008.
Years ago, a veteran investor shared this simple but honestly profound roadmap with Howard Marks. Stage 1, just a few forward-thinking people start buying. They see things getting better before anyone else. Stage 2, okay, the trend is becoming obvious. More people are catching on. But Stage 3 is the danger zone. That's when logic gets thrown out the window and everyone just concludes that the good times are here to stay forever.
And there it is. That's the peak of the pendulum swing. That's the moment of maximum greed, maximum optimism, and, because of that, maximum risk. It's so seductive because it feels like the safest time to invest. It feels like there's no risk at all. That was the mood in 2006, early 2007. The consensus was that risk had been engineered out of the system.
And of course, here's the inevitable flip side. The mirror image. Stage 1, a few thoughtful people start to see the cracks forming. Stage 2, the bad news is everywhere, you can't deny it anymore. And then Stage 3, that's when the pendulum is swung all the way to absolute despair. Everyone is convinced there is no bottom. They believe the financial world as we know it is ending.
This is exactly where we found ourselves in the fall of 2008, right after Lehman Brothers collapsed. The pendulum was stuck at its most negative, most fearful extreme. Everyone was absolutely convinced things could only get worse.
And it was precisely because of that universal pessimism that it became the moment of maximum opportunity for those who understood what was happening and had the courage to act.
There's this old saying that just captures this whole dynamic perfectly. The wise investor buys during stage 1 of a bull market, when it's scary, when it's unpopular. The fool, driven by greed and envy, finally jumps in during stage 3, right before the whole thing is about to reverse course.
So after all that, what's the actual takeaway here? I mean, how do we use this knowledge to our advantage? Well, the answer isn't about trying to predict the future. It's about being prepared for it. These are the dependable patterns. Think of them as the physics of the market that you can actually rely on. These are the rules of the game. You can be absolutely certain that psychology, not just fundamentals, is going to drive the market. You can be certain that extremes won't last forever. And you can be certain that the crash, the air rushing out of the balloon, will be a whole lot faster than the slow, steady boom that came before it.
However, and this is just as important, we have to be humble and admit what we can't know. Nobody can tell you exactly how high a bubble will go. Nobody knows the specific event that will finally pop it. And nobody can tell you precisely when that reversal will happen. Trying to pinpoint these things is a fool's errand.
So let's be really clear about this. Your edge doesn't come from owning a crystal ball. It comes from having a map and a compass. The goal is to develop the skill to just look around at the market, gauge the mood, and say, okay, it feels like we're pretty deep into the greedy side of the arc right now. Or, wow, it seems like fear is completely in the driver's seat. That recognition, that is your edge.
And that, of course, brings us to right now, to today. This is not a rhetorical question. This is the practical homework from this whole discussion. I really want you to think about it. Look at the news headlines, listen to the financial commentary, check in with your own feelings about the market. Are people generally more worried about losing money or more worried about missing out on opportunities? Is the overall mood more optimistic or more skeptical? Where do you think the pendulum is today?
Because at the end of the day, that's what this all boils down to. It's awareness. Awareness that the pendulum even exists. Awareness of market psychology and how it works. And maybe most importantly, awareness of your own emotional reactions to greed and fear. That self-awareness, that ability to step back and observe, that is the greatest, most durable edge any investor can ever hope to have.
You know, when we think about what it takes to be a great investor, our minds immediately go to spreadsheets, financial models, maybe some secret inside information, right? But what if I told you the single greatest challenge in investing has nothing to do with any of that? The real war, the one that truly separates success from failure, is fought right here between your own ears. It's all about mastering your own psychology.
This quote from the legendary investor Howard Marks it hits the nail on the head. It's wild when you think about it. So many of us have the brain power to read a financial statement or analyze a business model. But the ability to stand firm against the powerful and often totally irrational pulls of our own emotions, that's what's rare. Turns out, our own minds are usually the source of our worst mistakes.
So that's the big question, isn't it? If our own brains are setting these traps for us, what exactly are these psychological forces? How do they work? And most importantly, how do they sneak up on us and convince us to make disastrous decisions with our hard-earned money? Well, that's exactly what we're going to unpack.
All right, here's our game plan. First, we're going to identify the investor's inner enemy. We'll name the villains. Then, we'll watch them in action with a classic real-world story, the dot-com bubble. After that, we'll look at the inevitable crash that followed. And finally, we'll get practical and talk about how to build your own mental armor to fight back.
Okay, so let's get right to it and meet the villains of this story. And spoiler alert, they're not some shadowy figures on Wall Street. They are universal, powerful forces that live inside every single one of us, which makes them so incredibly tough to beat.
And here they are, the rogues gallery. You got greed, that simple desire for more that just spirals into recklessness. Then you've got its evil twin, fear, which can turn into absolute panic in a heartbeat. There's the strange one, willing suspension of disbelief. That's when we know something doesn't make sense, but we want to believe it anyway. Of course, there's the powerful pull of the herd mentality, the incredibly corrosive force of envy. Oh, and ego, the one that tells us we're a genius and can't lose. And finally, the one that gets so many people at the end, capitulation.
And this right here, this is the whole game. It's not about having a 160 IQ. Seriously, lots of brilliant people can build a perfect spreadsheet.
The real magic, the thing that so few people can actually do, is to keep your head when everyone around you is losing theirs. What you do with your analysis is what matters. And that's where psychology always wins.
Okay, theory is great, but let's see how this all plays out in the real world. And oh boy, do we have a story for you. We're going to rewind the clock to the late 1990s and take a hard look at the absolute insanity of the dot-com bubble. It is the perfect cautionary tale.
So you have to picture the scene. For 9 straight years, the stock market had been on an absolute tear. We're talking average returns of over 20% a year. It felt like a party that would never, ever end. A new paradigm. People were mesmerized by the story of the internet, and by the time a few sane voices started whispering warnings in early 2000, nobody wanted to listen. The momentum was just too powerful.
And this is where things just got plain nuts. You'd have a guy in the cubicle next to you telling you he just bought stock in some new IPO. He'd ask, cool, what does the company do? And he'd literally say, I have no idea. A week later, he's telling you he tripled his money, and he still doesn't know what they do. After you see that a few times, it's not just that you feel left out, you start to feel like a complete idiot for being responsible.
And that exact moment, that feeling when you just can't take it anymore and you throw your hands up, that's called capitulation. It's when every rational bone in your body, all your analysis, all your conviction, it all just snaps under the crushing weight of watching everyone else get rich. You surrender, you give up, and you jump on the bandwagon, usually right as it's about to fly off a cliff.
But here's the sneaky part. Manias aren't built on pure emotion. We're smart creatures. We tell ourselves a really compelling story to justify the craziness. Back then, the story was perfect. The internet changes everything, so old valuation rules don't apply. All these index funds and 401ks have to buy more tech stocks, creating a permanent waterfall of money. It all led to one simple, beautiful, and incredibly dangerous conclusion. Prices can only go up. It felt like a sure thing.
And this leads us to another one of our key villains, that willing suspension of disbelief. It's the magic ingredient in every single financial bubble in history. It's that little voice in our head that whispers, yeah, I know this sounds crazy, and yeah, I know this ended badly every other time. But this time it really is different. We want to believe it so badly that we just choose to.
Buffett absolutely nails it with this one. Seeing those stock prices just go up, up, and up, it's like a drug. It feels amazing. It makes you feel like a genius, and it completely sedates the part of your brain that's supposed to be asking, hey, wait a second, does any of this actually make sense? The rising price itself becomes all the justification you need.
So the dot-com bubble wasn't just one thing. It was this toxic cocktail of emotions all mixed together. You had a huge dose of pure greed for easy money. You mixed in a heavy pour of herd mentality that made you feel insane for not participating. You added a splash of envy for your neighbor's new sports car. You stirred in a little bit of ego because, hey, you're a genius now. And then you topped it all off with a massive, massive fear of missing out. It's a recipe for absolute disaster.
And the party rages on until it doesn't. Because things built on a foundation of pure emotion, they never, ever last. That euphoric wave that lifts everything to the stratosphere, well, it always, always comes crashing back down to earth.
And when it crashed, it was unbelievable. We're not talking about stocks falling 50% or even 90%. So many of these can't-miss companies, these darlings of the new economy, lost over 99% of their value. Just think about that for a second. A near total wipeout. Everything you put in was just, poof, gone.
I mean, just look at the whiplash in thinking. In 1999, the story was price is irrelevant. Profits are for old economy dinosaurs. 2 years later, it's, oh my God, this company is losing money every quarter. This is unbelievably dangerous. The entire logic of the mania just evaporated overnight and was replaced by cold, hard, painful reality.
And you know, this highlights one of the hardest parts of all this. For years during the boom, the people who were actually right, the disciplined, sober investors, they looked like complete fools. Their clients were firing them. Their neighbors were laughing at them. It takes a spine of absolute steel to stick to your principles when the entire world is calling you an idiot, right up until the moment you're proven spectacularly right.
Okay, so that was the horror story. But the good news is we can learn from it. And that brings us to the most important part of this whole discussion. How do we fight back? How do we actually build our own mental defenses so we don't get swept away the next time a mania comes to town?
So we've identified the enemy within. We've seen its playbook. The question now is, what do we do about it? What are the actual, tangible weapons you can put in your toolkit to defend yourself against your own worst instincts?
All right, here are 6 crucial weapons for your arsenal. Number 1, and this is the big one, have a strong sense of what a business is actually worth, its intrinsic value. 2, have the discipline to only act when the market price gets way out of whack with that value. 3, please learn from history. Market excesses are always punished. 4, be a student of human psychology. Know that these traps are real. 5, trust your gut. If it feels way too good to be true, it is. And finally, number 6, get comfortable with looking wrong, maybe even looking stupid in the short term. It is the price you pay for being right in the long run.
I love this quote from Joel Greenblatt because it's everything. That sense of intrinsic value, that is your anchor in a hurricane. It's your home base. It's your North Star. Without it, you are just adrift, tossed around by every wave of market news and popular opinion. It is the only thing that allows you to stand firm when those psychological forces are pulling you in every direction.
And it really all comes down to this. That ego, the part of us that wants to chase hot stocks so we can brag at a cocktail party, that's your worst enemy in this game. The real path to long-term success isn't glamorous. It's paved with humility, with knowing how much you don't know, with controlling your risk, and with staying grounded.
So, I'll leave you with this final thought. These manias, these bubbles, these crashes, they're not a glitch in the system. They're a feature. It's how markets work. They are absolutely going to happen again. So the only question that truly matters is this. When the next one comes, and believe me, it will you be ready for it?
All right, today we are going to dive deep into an investment philosophy that, let's be honest, just feels wrong. I mean, it goes against every social instinct we have, and it's probably one of the most psychologically difficult paths an investor can walk. It's called contrarianism, and what we're about to see is that its real power, well, it lies in that very discomfort. You know, this quote from Sir John Templeton really is the heart of it all, isn't it? It just perfectly nails the two sides of the contrarian coin. On one hand, the sheer courage it takes to buy when everyone else is absolutely panicking, and on the other, the incredible rewards that courage can unlock. It's the perfect place for us to start. Now, this sounds so simple, right? Just do the opposite of everyone else. But it's not about being stubborn or difficult for the sake of it. No. See, to get superior results, you need what the great investor Howard Marks calls second-level thinking. And that's a whole different ballgame. It's a deeper, more complex way of seeing the world that by its very nature, most people just don't do. So, to really get our heads around this, we're going to run what I like to call the contrarian's gauntlet. First, we'll lay out the core premise. Then, we're going to dissect why the crowd is so often wrong at the worst possible times. We'll face the psychological pain of this journey head-on, find a moment of real clarity in the 2008 crisis, and finally, we'll untangle what might be investing's greatest paradox. Let's get into it. Okay, first up, the contrarian premise. And look, this is not just about being a rebel without a cause. It's about strategically looking at what everyone else is holding, what we call the consensus portfolio, and seeing it not as a guide, but as the starting point for your counter strategy. And Warren Buffett, of course, just nails the execution. When you see the herd stampeding, fueled by either total euphoria or absolute panic, that's your signal. That's your cue to become more cautious, to take a step back, and to seriously consider doing the exact opposite. This right here is the essence of the contrarian mindset. And the engine that drives this entire strategy is what we just mentioned, second-level thinking. So here's the difference, right? A first-level thinker says, hey, that's a great company, let's buy the stock. Simple. But a second-level thinker says, yeah, it's a great company, but everyone knows it's a great company, which means it's probably overpriced and has absolutely no room for error. It's that ability to think one step beyond the obvious. That's where you uncover the real opportunity. So, if our goal is to think differently, we first have to understand why the crowd gets it so spectacularly wrong. And that brings us to Section 2, the logic of crowd error. And this isn't about gut feelings or hunches. There is a cold, hard logic for why the consensus is almost guaranteed to be wrong at the market's most extreme, most critical points. Just think for a second about how a market top actually forms. It's pretty simple. Buyers have to keep outnumbering sellers, pushing those prices higher and higher. This whole process continues until, inevitably, the very last person who could possibly be persuaded to buy finally does. And at that exact moment, who's left to buy? Nobody. The buying power is completely exhausted. The only direction left to go is down. And here is the absolute key takeaway. The crowd's belief is the very thing that creates the unsustainable peak or the panic bottom. So the very existence of a market extreme is, in itself, proof that the consensus is wrong. Think about that. At that single moment of maximum agreement, the crowd's position must, by definition, be the incorrect one. The logic, it's clean. It's almost elegant. But actually doing it, oh, that is a completely different beast. Welcome to Section 3, the uncomfortable path. This is where the clean theory gets tested by messy reality, because being a contrarian is psychologically grueling. It's just plain hard. To walk this path, you need way more than a clever idea. You need an iron stomach to stand completely alone. You need a deep conviction, one that's born from rigorous analysis, not just some hunch. You need patient supporters who actually trust you when things look bad. And maybe most critically, you need the resilience to look wrong, sometimes for a long while, so that you can eventually be proven right. The legendary David Swinson from Yale captured this perfectly. Your portfolio is going to look strange, maybe even imprudent to everybody else. Your best, most profitable ideas will often look like your worst, most foolish decisions to the outside world. And you have to be 100% okay with that. And this is really the key lesson of this whole section. If your investment feels comfortable, if it feels easy, if everyone agrees with you, you are almost certainly not in a position to earn superior returns. Profit is born from discomfort. Of course, all this theory was put to the ultimate test back in 2008, and that brings us to our case study in Section 4, an epiphany in crisis. Because in the sheer terror of the global financial crisis, a really profound lesson about what it means to be a true contrarian emerged. Let's just go back to that moment, mid-October 2008. Lehman Brothers was gone. Bear Stearns, gone. AIG, bailed out. There were real fears that Goldman Sachs and Morgan Stanley would fail next. The system felt like it was teetering on the absolute edge of collapse, and any positive outlook was just dismissed as pure fantasy. It was terrifying. Now, most of us think of skepticism like this, right? When things are booming, the market's flying high, the skeptic is the one in the corner saying, whoa, hold on a second, this is too good to be true. And it's what protects you from bubbles and manias. It's absolutely essential, but it's only half the story. And here is the epiphany. True contrarian skepticism has to be symmetrical. It doesn't just question wild euphoria. It also requires you to stand in the middle of a firestorm of panic and have the clarity to say, wait a minute, this is too bad to be true. You have to be just as skeptical of overwhelming pessimism as you are of overwhelming optimism. And that was the key. In the absolute depths of 2008, when the consensus view was Armageddon, the true contrarian move wasn't to sell more. It was being skeptical of that very pessimism. The ultimate act of contrarianism was to be an optimist and buy. All of this brings us right to our final section, the idea that really ties everything together. Section 5, Investing's Greatest Paradox. And it's the central truth of this entire philosophy. In investing, what feels good is usually bad for you, and what feels absolutely terrible is often where the real opportunity is hiding. This slide just lays it all bare. This is the investor's choice. On one side, you've got everything that feels comfortable and safe, following the herd, waiting for the dust to settle, buying what's popular. On the other side, you have what's often profitable, taking a lonely position, buying amidst total uncertainty, and yes, attempting to catch what they call falling knives. All of our instincts pull us to the left, but the real rewards, they're almost always on the right. Just let that sink in for a minute. The very idea of a hugely profitable investment that feels comfortable and easy right from the start, it's basically an oxymoron. It doesn't exist. That churning in your stomach, that feeling of discomfort, that's not a warning sign to stay away. That's the price of admission. That's your ticket to an opportunity that the crowd is too scared to even look at. And this is exactly why waiting for comfort is a losing game. Because by the time the knife has finally stopped falling, by the time the dust settles and all the good news is out, the bargain is gone. The potential for those extraordinary returns, it just evaporates the moment the discomfort and the uncertainty are removed. So how do you do it? How do you actually stand firm in the middle of the storm? The entire strategy, all of it, hinges on one thing. Your own, well-reasoned, deeply researched calculation of an asset's intrinsic value, what it's truly worth, completely independent of its crazy market price. That conviction is your anchor. It's the only thing that gives you the courage to buy when everyone else is selling in a blind panic. In the end, this entire explainer really just boils down to one simple personal question. The logic is clear, the history is compelling, but knowing the path and actually walking the path are two very, very different things. So I'll just leave you with this. Are you truly prepared to be uncomfortable?
All right, welcome. Today we're not just going to talk about finding good companies. No, we're going a layer deeper. We're going to walk through the expert process for finding investments that are truly, genuinely undervalued. It's a subtle difference, but believe me, it's the one that separates the real pros from everybody else. So how do you actually spot a bargain in the wild? Let's open up the playbook.
Okay, so here's the game plan for today. We're going to kick things off with the single most common mistake that trips investors up. Then, we'll build a solid framework for how to actually select investments. After that, we'll dive into the psychology of what creates a bargain in the first place. And from there, it gets really practical. We've got a shopping list, some real-world examples, and we're going to finish up by uncovering the one condition you absolutely need to find the holy grail of investing.
All right, let's start right at the heart of the matter. We're going to tackle the central conflict that trips up almost everyone, even people who've been doing this for years, and that is the huge difference between a great business and a great price. I want you to really think about this for a second. Is a great company always a great investment? Your gut instinct, your first reaction, is probably to say, yeah, of course, right? I mean, we're all trained to look for high-quality, successful companies. But here's the thing. Believing that a great company is automatically a great investment is probably the single most expensive mistake you can make. They are just not the same thing.
And here it is, laid out plain and simple. This is that critical distinction. Over here on the left, you've got objective merit. The shiny, popular, well-run company that everybody's talking about. It looks great. But over on the right, you have the actual investment opportunity, and that's an asset that is priced below what it's really worth. Confusing the shiny object on the left with the smart purchase on the right, well, that's where most people get into a whole lot of trouble.
Man, this quote just cuts right through all the noise, doesn't it? Our goal isn't to find good assets, but good buys. It's such a simple idea, but it is so powerful. You could have the most innovative, world-changing company, and it could be a terrible investment if you pay too much for it. And on the flip side, some boring, overlooked, forgotten company can be an absolute home run if you get it cheap enough. In the end, it's not what you buy, it's what you pay. Okay, so let's move on and see how we take this core principle and actually build it into a disciplined process. Because this isn't about finding that one magical perfect investment out there. It's really about making smart choices among all the options that are actually available to you. So where in the world do you even start? Well, before you can think about buying anything, you have to define your hunting ground. The source material here calls it the feasible set. I like to think of it like building a fence around a huge forest. You're not going to look at every single animal out there. You're just focused on what's inside your fence. And you build that fence by filtering out anything you don't really understand, or industries that seem too speculative, or just any risks you're not comfortable taking. That's your turf.
So once you've got your turf defined, the real work starts, and it begins with these 4 raw materials. First, you need your list of potential investments, everything inside your fence. Second, you need to come up with an honest estimate of their intrinsic value, what you think they're actually worth, not just what the stock market says today. Third, you've got to compare the current price to your estimated value. And finally, and this is crucial, you have to have a clear-eyed understanding of the risks involved with every single one of them.
And this quote from Sid Cottle just nails it. Investment is the discipline of relative selection. Let's break those 2 words down because they're so important. Discipline means this is a process. It's rigorous. You can repeat it. It's not just a hunch. And relative. Relative is the key to the whole thing. You're never looking for a perfect investment in a vacuum. You are always choosing the best available option from your list at this moment in time.
Now, this brings up a pretty big question, right? If the market is supposedly so efficient, full of smart people and supercomputers, then how on earth do these bargains even exist in the first place? Well, the answer has a lot less to do with math and spreadsheets, and a lot more to do with human psychology.
So first, let's look at the psychology of a bubble. It's fascinating, really. It always starts with a good story, a genuinely attractive asset, or a cool new idea. People get excited, Opinions start to rise. Money starts pouring in. That makes the price go up. And then, and this is the key, that rising price becomes its own advertisement. It's seen as proof that the story was right all along, and not just creates this feedback loop, a popularity contest that just spirals up and up and up until the price has nothing to do with reality anymore.
The process that creates a bargain is the exact same machine, just running in reverse. It's a vicious cycle. It usually starts with a real objective problem, some kind of flaw.
That flaw leads to neglect, or maybe even scorn from the market. Capital runs for the exits, which pushes the price down. And just like before, that falling price is then seen as proof of high risk, which scares even more people into selling. It's a downward spiral fueled by negativity, unpopularity, and just plain fear.
So when you put all those pieces together, these are basically the ingredients for unpopularity. A potential bargain gets created when an asset has some kind of real, visible weakness, when the media either ignores it or actively trashes it, and when its falling price terrifies anyone who just looks at the chart. The opportunity is literally born out of fear and misunderstanding.
Okay, so if we know the psychology behind it, where should we actively go looking for these opportunities? I mean, where do these unpopular, misunderstood assets tend to hide out? Well, the source material gives us a fantastic, really concrete checklist for any aspiring bargain hunter.
This right here is the Contrarian shopping list, and as you read through it, notice the theme. Every single one of these items should probably make the average investor a little bit queasy, little known, questionable, controversial, or scary, unloved, poor returns. This isn't just a list of characteristics, it's basically a list of things that are emotionally really difficult to buy. And that discomfort, well, that's exactly the point.
And this quote from the legendary investor Seth Klarman, it's the perfect summary of that entire list. That feeling of discomfort, that stigma, that emotional revulsion you might feel when you look at an asset, that is often a giant, flashing signpost pointing directly toward potential value. The worse it feels to consider buying it, the better the potential price might be.
Okay, so this all sounds great in theory, but what does it actually look like in practice? Let's look at 3 specific, big-picture examples to see how this whole contrarian playbook has actually translated into massive opportunities in the real world.
This table just breaks it down so well. Let's take convertible securities. The mainstream objection was, they're too complex, and they're issued by weak companies. But the contrarian opportunity was that because they were so unloved and unpursued, they were likely underpriced. Same thing for high-yield bonds. They were dismissed as junk, people were afraid of default. The opportunity? An entire asset class was being written off without anyone even looking at the price. And finally, distressed debt. Investing in bankrupt companies just feels irresponsible, right? But the contrarian knows that the thing everyone considers the worst has a very high chance of actually being the cheapest.
I love this quote. It just perfectly captures the whole attitude around convertible securities at the time. The very idea that dismissed them, this macho attitude that real men only buy pure stocks or bonds, was the exact reason they became a bargain for anyone willing to be called a chicken. And here it is. This is the flashing red light for junk bonds. Think about that statement. How can anyone make a blanket dismissal of an entire category of investments without any reference to price? The moment you hear something like that, a bell should go off in your head. It signals a huge emotional bias. And where there's bias, there's often opportunity.
So, this whole journey through process and psychology and history, it brings us right to the end, to the most important takeaway from this entire playbook. This is the one condition you need to find what investors call the Holy Grail.
And it all boils down to this one single idea. If you take nothing else away today, remember this. The Holy Grail condition for any bargain is when there is a massive gap between perception and reality. Your job as a contrarian is to find those assets where the popular story, the common perception, is dramatically worse than the fundamental truth. That gap, that is where value is hiding.
And so I'll leave you with this final, powerful question to ask yourself, because this playbook is useless unless you actually apply it. So look at the headlines, listen to the chatter online, and just ask yourself, what is everyone else ignoring today? What is too controversial, too scary, or just too boring for the crowd to even bother with? Because the answer to that question, well, that might just be where you find your next great investment. Thanks for joining me.
Welcome to The Explainer. Today, we're going to break down an investment philosophy that honestly feels like it goes against every instinct you have. It's called patient opportunism. And really, it's about the art of doing absolutely nothing until that one perfect moment shows up. If you can get this right, it can be the difference between just getting by and seizing a truly life-changing opportunity. Okay, so let's just start with a cold, hard dose of reality from the investment strategist Peter Bernstein. You really got to let this one sink in. You can't just go to the market and say, hey, my financial plan needs an 8% return this year. The market is not your friend. It's not accommodating. It is completely 100% indifferent to what you need. It's going to do whatever it's going to do. So that begs the really big question, right? If you can't bend the market to your will, what can you do? What's the most powerful move you have? The answer isn't about working harder or trying to outsmart everyone. No, it's about fundamentally changing how you approach the game itself. To get our heads around this new approach, we're going to walk through 5 key ideas. First, we'll look at the investor's action bias. That's the psychological trap that makes you feel like you've always got to be busy. Then, we'll get into the art of doing nothing. After that, we'll explore the biggest threat to this whole strategy, the danger of reaching. We'll see how this all comes to a head when a crisis creates opportunity. And finally, we'll tie it all together with the patient investor's mindset. All right, Section 1. Let's dig into the default setting for so many investors, the thing that gets them into so much trouble. It's this constant nagging feeling that you have to be doing something. You know, it's a totally natural human impulse. We think that if we're not trading, if we're not tweaking our portfolio, then we're not being proactive, we're not in control. But you know what? The data tells a completely different story. Study after study shows a really clear pattern. The more individual investors trade, the worse they tend to do. That urge to act, it's powerful, but man, is it costly. And don't for a second think this is just a rookie mistake. As the great investor Joel Greenblatt says here, even the pros, the people who get paid big bucks to manage money, they struggle with this. Imagine showing up to your job every day where the smartest thing you can do is nothing. It just feels wrong. But in investing, sometimes the most profitable move you can make is to just sit on your hands. So, if being busy all the time is the trap, what's the way out? Well, the escape plan is to master the art of doing nothing. And look, this isn't about being lazy. It's about a massive mental shift from constant motion to patient, strategic waiting. It's about waiting for your pitch. Warren Buffett has this absolutely brilliant analogy he took from baseball legend Ted Williams. Williams knew he was only a great hitter if he swung at pitches in his sweet spot. But in baseball, you know the deal. 3 strikes, you're out. You have to swing. But here's the absolute game changer for an investor. In the market, there are no called strikes. Think about that. You can stand at the plate and watch hundreds, even thousands of pitches go by. Overpriced stocks, speculative bubbles, weird financial products. And there is zero penalty, none. Your entire job is to just wait patiently for that one, single, perfect pitch, the one that's right down the middle, just for you. You know, this idea of waiting for the cycle to bring the opportunity to you, it actually has a deep parallel in the Japanese concept of mujo. It's this profound acceptance that everything changes, that nothing is permanent. Cycles are just part of nature. Markets will boom and then they'll bust. Instead of fighting that current, you accept it, you understand it, and you position yourself to act when the cycle finally turns in your favor. But man, is patience hard. It's especially hard when you feel like you're falling behind or like everyone else is getting rich. And that brings us to the single most seductive danger for an investor, a behavior known as reaching for yield. Let's try an analogy. Picture the market as a big tree and you're a cat. You're hungry and you need dinner. That's your investment return. The problem is, the food on the ground, the really safe stuff like government bonds, well, there's just not much of it. The returns are so low, they're barely a snack. So, you're being motivated by 2 incredibly powerful forces. First, there's the stick. That's the pain of those tiny returns on the ground. It's pushing you to do something, anything else. And then you look up and you see the carrot, the promise of a delicious, full meal way higher up in the tree on some riskier-looking branches. So what does the cat do? It starts to climb. Pushed by that stick and pulled by that carrot, it goes higher and higher, scrambling out onto thinner and thinner branches. It's taking on more and more risk, and a lot of the time, it doesn't even realize how dangerous its position has become. This is a perfect picture of what Wall Street calls reaching for yield. And this, right here, is where it all goes wrong, because sooner or later, the weather always changes. The wind starts to howl, the branch begins to shake, and all those hidden risks suddenly become very, very real. In a market crisis, all the cats who climb too high come tumbling out of that tree at the exact same time. The 2008 financial crisis is the ultimate textbook example of this. For years, low interest rates pushed everybody up the tree. To juice their returns, investors used incredible amounts of leverage. That's borrowed money. But then the housing market cracked, prices started to fall, and pure panic took over. Lenders wanted their money back, and they wanted it back now. This is called a margin call, and it's not a friendly request, it is a demand. And that demand triggered a catastrophic tsunami of forced selling. In a crisis, the world splits into 2 kinds of people. You've got the forced sellers. Those are the cats who fell from the tree. They basically have a gun to their head. They have to sell. Not because it's a good idea, but because of margin calls or because their own investors are panicking and pulling their money out. And they're trying to sell into a market where nobody is buying. And then you have the patient buyer, the one who stayed on the ground, who kept their cash, their powder, dry, and they are now ready to buy from people who literally have no other choice. There's even a piece of Wall Street slang that perfectly captures this desperation. It's called a BWIC, pronounced BWIC. It stands for Bid Wanted in Competition. This was basically the emergency fire sale. It's what happened when banks seized the portfolios from investors who blew up, who couldn't meet their margin calls. And in these auctions, the sellers, the banks, they weren't trying to get a good price. They were just trying to get out. It was an absolute bloodbath for anyone who was forced to sell. And you want to know what that bloodbath looked like in reality? Okay, check this out. We're talking about assets like senior secured bank loans. Now, these are things that are normally considered super safe. They almost always trade right at face value, 100 cents on the dollar. During the crisis, they were being dumped for as low as 60 cents. 60. I mean, think about that. That's not a sale. That's not a bargain. That is a once-in-a-lifetime opportunity, and it was only available to those who had the cash and the nerve to step in. So this is the whole point, right? Understanding what it takes to be on the right side of that trade when the moment comes. How do you make sure you're the one buying at 60 cents and not the poor soul being forced to sell? The entire philosophy of patient opportunism is about preparing for the hurricane when the sun is shining. The goal is to build a financial fortress around yourself, one that can easily withstand the panic. Because that way, when everyone else is running for the exits, forced to sell at any price, you are one of the very few people with the cash and the stability to be a buyer. So what do you need to build that fortress? Here are the 4 essential items in your toolkit. First, a hardcore focus on value, knowing what something is actually worth and only buying it for less. Second, little to no leverage. Debt is the fuse that turns a market downturn into a personal disaster. Third, you need long-term capital, money you won't need back tomorrow or next year. And finally, and maybe this is the most important of all, you need a strong stomach. You need the emotional strength to buy when every headline is screaming, sell, and every fiber of your being wants to run and hide. And this brings us to the simplest, most powerful tool of all, and Seth Klarman says it perfectly here. In normal times, holding cash feels stupid. Right? Your financial advisor says be fully invested, you see the market going up, but that cash, that dry powder, is what gives you options when no one else has any. In a crisis, cash isn't just king, it's the whole kingdom. It's the only ticket that gets you into the game. And so that's the question we're left with, because you have to know there will be a next time. The cycles of greed and fear, they're just hardwired into us. So the choices you make now, during the calm times, the decision to fight that urge to always be doing something, to avoid reaching for that extra bit of yield, and to patiently keep some powder dry, those choices will determine everything. They'll decide if you're going to be a forced seller or if you're going to be the one who gets to buy. You know, we live in a world that is just obsessed with prediction, right? We're constantly trying to figure out what the stock market's going to do tomorrow, where interest rates are headed next year. We crave that certainty. But what if that whole game is just flawed from the very beginning? In this explainer, we're going to dig into a really powerful and, honestly, a pretty liberating idea, the incredible value of just admitting you don't know. So let's kick things off with this absolute gem from the economist John Kenneth Galbraith. It's so sharp and it just perfectly sets the stage for us. What he's really saying is that certainty, it's an illusion. He's splitting forecasters into 2 groups. You've got the ones who are actually aware of their own limitations. And then you have the second group, and this is the really dangerous one, the ones who are so confident, but that confidence just isn't backed up by reality. And here's the perfect companion to that thought from the brilliant psychologist Amos Tversky. See, it's not just pure ignorance that'll get you in trouble. It's that illusion of total knowledge, that feeling that you know everything, that can be just as destructive, maybe even more so. So these 2 quotes, they really frame the problem we're looking at today, this dangerous, magnetic pull of false certainty. Okay, so let's dive into what we can call the forecaster's fallacy. We're going to really unpack this deep-seated belief we all have that we can and that we should be able to predict the big picture future, and why that very belief so often leads us right off a cliff. So here's the core argument, right? The main idea for this whole thing. It's my belief that trying to reliably predict the macro future, big stuff like economies and markets, is just incredibly, incredibly difficult.
And this idea that there are a few special people out there with a crystal ball who can consistently beat the system, well, let's just say I'm highly skeptical. Now look, it's one thing for me to just say that. It's another thing to actually prove it. So let's put this whole idea on trial. We're going to conduct a little investigation of our own, using real-world data from Wall Street Journal polls to see just how useful all these expert economic forecasts really are. All right, first question in our investigation, and it's the most basic one we can ask. You take a look at all these predictions from dozens and dozens of economists, talking about interest rates, exchange rates, the whole shebang. Were they, as a group, even close? Did they get it right? And the evidence comes back with a swift, clear verdict, a big, fat no. On average, their predictions were off by 15%. Now, 15% might not sound like the end of the world, but trust me, in finance, a miss of that size is absolutely massive. That can easily be the difference between making a nice profit and taking a really painful loss. Okay, so they weren't very accurate. Fine. But maybe, just maybe, they were still valuable in some way. I mean, a forecast is really only useful if it helps you see a big change coming, right? Nobody makes a ton of money by predicting that tomorrow will be pretty much like today. So the real question is, did they see the big shifts coming down the pike? And this right here is the absolute killer finding. The predictions failed at the exact moment they were needed the most. The data shows that these forecasters consistently and completely missed the major turning points in the market. Think about that. Right when the road was about to take a huge, sharp turn, the consensus forecast was still calling for a perfectly straight line ahead. There was almost zero connection between what they said would happen and what actually did. So this naturally leads to the next big question. If these forecasts weren't based on some brilliant insight into the future, what were they based on? I mean, what was the method behind these consistently wrong predictions? And the answer is, well, it's almost comically simple. Extrapolation. The huge majority of these so-called expert forecasts were really just a projection of what had happened in the very recent past. It's literally like trying to drive a car down a winding road by looking only in the rearview mirror. Sure, it tells you exactly where you've been, but it is completely useless for seeing that hairpin turn that's right in front of you. But wait a minute, I know what you're probably thinking. Come on, with dozens of these experts all making predictions, somebody had to get it right, even just by pure luck. Were there any flashes of brilliance in all this data? And you know what? The answer is a firm yes. In every single one of these surveys, there was always somebody who was almost perfectly correct. Someone who, against all the odds and the flawed consensus, just absolutely nailed it. But, and this is the single most important part of the whole investigation, there's a huge catch. So, here it is, the final question of our little trial, and this one gets right to the heart of the matter. If we can actually point to real people who made these brilliantly accurate forecasts, why should we stay so skeptical about the whole thing? Because, as they say, even a broken clock is right twice a day. The key thing to remember is this: getting it right once is meaningless. What really matters is consistency. And when you dig into the data, the person who looked like a genius in one survey was often completely lost in the next one. The winners were this constantly revolving door of different people, which is a huge clue that luck, not skill, was what was really driving the results. So all of this brings us straight to what we can call the great investing dilemma. It's this paradox that sits right at the center of trying to use predictions to make decisions, and it explains so clearly why they're often worth so little in the real world. This right here, this is the logical heart of the entire argument. So let's just walk through it, step by step. 1. Forecasts usually just predict more of the same. 2. Most of the time, the future is more of the same, so the forecasts look correct. But, and this is the big one, that correctness has almost no value because the market already expects that to happen. It's priced in. 4. Every once in a while, the future is radically different, a crash, a boom, something unexpected. 5. That's the moment an accurate forecast would be worth a fortune. That's 6. That is also the exact moment when forecasts, which are based on the past, are almost guaranteed to be wrong. And finally, while yes, someone might get it right in those moments, it's never the same person twice. So what's the conclusion? On balance, macro forecasts are just of very little value. Okay, so if we agree that relying on forecasts is a really flawed strategy, what's the alternative? Well, this brings us to a fundamental fork in the road, a choice we all have to make between two completely different philosophies of how to deal with the future. Over on the left, you've got the I know school. These are the folks who believe that knowing the future is absolutely essential, and more importantly, that they can do it. They make big, bold, confident bets based on their opinions. Then on the right, you have the I don't know school, and they start from a place of humility. They believe you can't know the macro future, but here's the key. They also believe you don't have to. Their entire goal is to invest as intelligently as possible without that knowledge. They're cautious, they diversify, and they are totally comfortable saying, I don't know, which, by the way, saves them from those catastrophic losses that happen when you're confidently wrong. So what does it actually look like to be a card-carrying member of the I don't know school? Well, this last section is all about making that mental shift, moving away from prediction, which we've seen as basically useless, and toward preparation, which is where true, lasting resilience is built. Let's play this out in the real world. The I know investor, totally sure about their vision of the future, acts aggressively. They put all their eggs in one basket, they use leverage to juice their returns. The I don't know investor is way more cautious. They spread their bets, they hedge their risks, and they focus on real, tangible value today. Now, in the years leading up to a big crash, say like 2008, that first group looks like a bunch of geniuses. They're killing it. But when the unpredictable finally happens, it's the second group, the prepared group, that's left standing, ready to pick up the pieces while everyone else has been wiped out. The real danger, then, is just overestimating what you can possibly know. You know, the biggest financial disasters happen when people forget that the most likely outcome isn't the only outcome. They build their strategies to work perfectly in the future they expect, but they totally ignore the small chance of a completely different, crazy tail event. And that underestimation of the unknown is exactly what leads to those massive portfolio-killing losses that seem to come out of absolutely nowhere. And really, has anyone ever summed this up better than Mark Twain? This is the ultimate lesson. The biggest risks we face don't come from our ignorance, they come from our arrogance. They come from acting with total certainty on something that just turns out to be flat out wrong. So, we end here. If we can just accept that the macro future is fundamentally unknowable, then the entire game changes. The most important question you can ask yourself is no longer, what do I predict is going to happen? Instead, it becomes, how have I prepared myself for all the things I can't predict? Making that simple shift in how you think, well, that's everything. All right, let's talk about one of the biggest challenges for any investor. I mean, really the biggest challenge. It's trying to figure out the future, right? We're all kind of caught in these market cycles, these massive waves that can either lift us up or, completely wipe us out. So the big question is, how in the world do you handle something that's so important but also completely unpredictable? Well, today we're going to dig into a really powerful idea that just might offer a better way. This sentence right here, this is everything. It's the core idea, the guiding light for our whole conversation today. And honestly, it might be one of the most important bits of investing wisdom you ever come across. Think about it. Success isn't really about being a fortune teller who can predict when it's going to rain. It's about being smart enough to know when it's time to start building an arc. So let's really unpack what that means for us as investors. Anyone who's ever put a single dollar into the market has to deal with cycles. There's just no escaping it. They're the heartbeat of the financial world, right? The constant ebb and flow, the booms and the busts. It's almost like a force of nature, like a powerful river. Our job isn't to stop the river, because we can't. It's just to learn how to navigate it without getting capsized. Okay, so when you put these three things together, you get what I call the ultimate investor's dilemma. First off, these cycles, they're inevitable. They've always happened, they're always going to happen, period. Second, they have a huge impact on how well you do. And third, and this is the real kicker, they are completely, totally unpredictable. No one knows when they'll turn, how high they'll go, or how low they'll drop. So you're up against this force that's incredibly powerful, but also a total mystery. So, what's the move? Well, when faced with a problem like that, most people tend to go down one of two roads. The first road is trying to outsmart the whole thing, be the hero who predicts the cycle. The other road is to just pretend it doesn't exist, to ignore it. Now, both of these might seem like reasonable strategies on the surface, but as we're about to find out, they're both dead ends. So on one side, you've got the fortune tellers. These are the folks pouring tons of money, complex models, and all their brain power into trying to predict the future. And what's the problem with that? Well, history has shown us time and time again that it just doesn't work. No one can do it consistently. It's a fool's errand. Then on the other side, you've got the ostriches.
basically sticking their heads in the sand. Their logic is, hey, since I can't predict it, I'm just going to ignore it. This is your classic buy and hold no matter what strategy. But the issue here is huge. You just stand there and watch as a bubble gets bigger and bigger, and then you do nothing when it pops. You miss massive chances to protect your money and to buy great stuff when it's on sale after a crash.
Okay, so if trying to predict the future is impossible, and just ignoring the whole thing is frankly irresponsible, then what are we supposed to do? This is the million-dollar question, isn't it? Are we just stuck between a rock and a hard place? Or is there another way?
And the answer is yes, there is a third way, and it requires a total shift in how we think about this problem. It's not about trying to be a psychic and predict the future, it's about becoming a detective and understanding the present. The whole goal is to get a really good sense of where we are right now in the cycle, and then, and only then, act on that information. Are we in a time of crazy, wild-eyed optimism, or are we in the depths of pessimism? Is money easy to come by, or is it tight? See, unlike the future, these are things you can actually figure out.
And this brings us right back to that key idea, our North Star. This is what that quote actually means in the real world. You stop obsessing about the unknowable future, and you start paying incredibly close attention to the observable present. It's about becoming a student of your environment, and I'm telling you that one simple shift in perspective, it's the foundation for a much, much smarter way to invest. All right, so if our big job is to know where we are, the next logical question is, how? How do we actually do that? Well, the key is to learn how to take the market's temperature. It's about feeling the mood in the room, gauging the climate by watching what everyone else is doing. And honestly, there is no better or more painful example of this than what happened in the years leading up to the 2008 financial crisis. The one skill you absolutely need for this is inference. Think about it. Everybody sees the same news, the same headlines, the same data. But only a handful of people stop and ask the really important question. Okay, but what does this mean? What is this event telling me about how other investors are feeling right now? What does it reveal about the psychology of the crowd? That's inference. It's the art of reading between the lines, of understanding the real story behind the story. Man, those years before 2008, they were just a master class in crowd psychology. It's a perfect case study, a really painful one for sure, but it shows exactly how a sober, clear-eyed look at the present could have helped people sidestep the absolute train wreck that was coming. And believe me, the warning signs were flashing bright red for anyone who was actually looking. This wasn't some secret, hidden information. It was all out in the open, in public reports. I mean, you had record levels of super risky debt being sold. You had companies borrowing money not to invest in their business, but just to pay dividends to their owners. Think about that. Lenders were so desperate to make deals, they were just throwing out basic protections, these things called covenants. And private equity firms, they were in a frenzy, paying insane prices for companies and loading them up with ridiculous amounts of debt. Put it all together and it was screaming one thing. This market is overheated, nobody is skeptical, and it is incredibly, incredibly risky. So if you saw all that happening, what was the right conclusion? What was the inference you were supposed to make? Well, it boils down to this single, chilling phrase. It captured the environment perfectly. What was happening was that there was so much money sloshing around, and everyone was so desperate to invest it that they were basically tripping over each other to make deals. They were lowering rates, dropping their standards, paying crazy prices, anything to put their money to work. The market had turned into a total seller's paradise, and for a buyer, an absolute nightmare. The risk was just, you could feel it in the air. Okay, that's the past, but how do we use this lesson right now, today? Well, let's make this really practical. Let's go through a simple checklist, a tool you can actually use to help you take the market's temperature in a more organized way. So the first part of this guide is all about the big picture, the overall environment. You ask yourself, is the economy humming along or is it struggling? Is the general feeling out there positive and optimistic or is it negative and fearful? And this one's key. What's going on in the capital markets? Are banks and lenders throwing money at people, or are they holding it tight? Are the deal terms easy, or are they tough? All of these things basically tell you how much fuel is available to be thrown on the market's fire. All right, the second part of the checklist zooms in on people, on investor behavior and what's happening with prices. Are investors feeling greedy, or are they feeling fearful? Are they scrambling to buy anything they can get their hands on, or are they completely uninterested? Are prices way up here, or are they down in the dumps? Now, here's the single most important piece of advice here. If you go down this list and most of your check marks end up in that left column, the one where optimism is high, prices are high, and nobody seems to care about risk, that's your signal. That is the time to clutch your wallet and be extremely cautious.
And let me just be crystal clear about something. Using a tool like this is not about trying to predict the exact top or the exact bottom of the market. That's the old game, the one we already know doesn't work. No, this is all about adjusting your behavior based on the environment you're in. It's like driving a car, right? You don't press the gas pedal the same way on a wide-open highway as you do in a crowded parking lot. In the same way, you should be more aggressive when the market climate is fearful and way more cautious when everyone around you is euphoric.
Look, at the end of the day, the market is always talking to us. It's constantly telling a story about what's happening right now. It's revealing the psychology of the crowd, that eternal tug of war between greed and fear, between healthy skepticism and blind belief. It is all right there, out in the open for anyone to see. So the only real question left is, are you paying attention? Are you taking the time to draw the right conclusions? That's a choice that every single one of us gets to make.
Welcome to The Explainer. All right, let's get right into it today and talk about a force that, shapes our lives way more than we like to admit, and that's luck. We love to take credit for our wins, chalk it all up to skill, but what if a huge chunk of our success is just the roll of the dice? Let's unpack that.
To kick things off, let's look at this quote from the author Nassim Nicholas Taleb. It just cuts right to the heart of what we're talking about today. I mean, on a spreadsheet, 10 million bucks is 10 million bucks. But how you got it, the process, that changes everything, doesn't it?
An accountant's going to look at the two piles of money and say they're identical. But we know, deep down, they're not. One of those fortunes came from a completely insane, unrepeatable risk. The other came from years of repeatable skill. And that huge difference? That's randomness. Learning to spot its influence is, I think, one of the most powerful mental tools you can have.
Now, there is probably no place where this confusion between skill and luck is more common or more expensive than in the world of investing. We want to believe it's this logical, orderly place where smart moves always lead to good results. But the truth, a huge amount of success is just being in the right place at the right time.
And this is absolutely crucial to understand. In the short term, somebody who's just being super aggressive and taking on massive risks during a bull market can look like an absolute genius. Their timing looks perfect, their track record is incredible, but does that really prove they have any skill? Or were they just the luckiest person at the table?
So, how can pure dumb luck create such a powerful, convincing illusion of skill? Well, Warren Buffett came up with his brilliant little thought experiment that just perfectly explains how we get fooled by randomness all the time.
Okay, so imagine this. Every single person in America, at the time, about 225 million people, starts with $1. Every morning, they all get together and flip a coin. You call it right, you win $1 from someone who got it wrong. Simple as that.
So after just 10 days, 10 flips, you'd have something like 220,000 people who have guessed right 10 times in a row. They've each turned their one little dollar into over $1,000, all just by chance. You can bet they're starting to feel pretty good about their coin flipping technique by now. Now let's fast forward to day 20. After 20 correct guesses in a row, you're down to about 215 people. But get this, each one of them has turned their single dollar into over $1 million. These people would be on TV, they'd be writing books about their strategies, they'd be selling out seminars, and it was all based on absolutely nothing more than a wild, lucky streak.
And this table here just nails our fundamental mistake. Our brains are wired to see patterns even when there are none. So we are constantly mistaking the things on the left, pure luck, randomness, coincidence, for the things on the right, skill, cause and effect, determinism. We look at that coin-flipping millionaire and our brain turns that lucky idiot into a skilled investor.
Okay, this brings us to what I think is maybe the most powerful, most important concept in this whole explainer. It's the idea of alternative histories. And once you start seeing the world through this lens, you will never look at success and failure the same way again. Here's the key insight. The reality that we see, the one successful outcome that actually happened, is just one of countless other possibilities that could have happened. This means that a great result doesn't automatically prove the decision that led to it was a wise one. It might just be the one timeline out of 1,000 where a crazy, reckless bet actually paid off.
I mean, think about it. For every famous general or celebrated inventor that we read about in the history books, there were probably thousands of others, people who were just as smart, just as courageous, who took similar big risks. But their roll of the dice came up snake eyes. Their alternative history played out, and now they're just forgotten footnotes. So this idea of all these invisible histories, it forces us to do something that's actually really hard for our brains. We have to separate the quality of a decision from the quality of the outcome. It's a tough mental shift, but it is so important. Let's run a quick thought experiment to really make this stick. Imagine some entrepreneur decides to build a massive, fancy ski resort in the middle of Miami. Everyone says they're nuts, but then a completely unprecedented, once-in-a-millennium freak blizzard hits South Florida and dumps 10 feet of snow. The resort makes an absolute fortune.
So, the big question is, was that a good decision? Of course not. It was a terrible, illogical decision that got bailed out by unbelievable, miraculous luck. A good decision is one that's sound and logical based on what you know at the time you make it, not one that just happens to get lucky with a 1 in a billion event.
So here's the real takeaway. We have to get good at judging the process behind a decision, not just the random outcome. As you can see here, good, sound decisions can absolutely lead to bad outcomes sometimes. And as we just saw, terrible decisions can get incredibly lucky. In the short term, results can be total imposters, hiding foolishness or masking real wisdom.
Okay, so once you really start to appreciate the power of luck, you'll see that it leads to two completely different ways of looking at the world, especially when it comes to investing. It all boils down to whether you operate from a place of I know or a place of I don't know.
On the left here, you have the I know school. These are the people who believe the future is basically predictable. They build their portfolios for one specific outcome. When they win, it's because they're smart. When they lose, they blame bad luck. But on the right, you have the I don't know school. They accept that the future is uncertain. They prepare for many possible scenarios, and they understand that even the best decision can still end up with a bad outcome.
So, if we accept that we can't really know what the future holds, then how in the world are we supposed to act? What's the game plan? Well, that I don't know school gives us a very clear defensive framework for how to operate in an uncertain world.
And this whole framework is really built on a few core ideas. It starts with a healthy respect for risk and just humbly admitting you don't have a crystal ball. So instead of trying to predict one specific outcome, you plan for a whole range of possibilities. The goal isn't always to hit a home run. It's to make sure you don't strike out. It's all about playing defense.
This quote right here just captures that entire philosophy perfectly. For people who truly understand the role of luck, the number one goal isn't to be the hero who gets rich on one lucky bet. The goal is just to make sure you survive, that you're still in the game after that inevitable streak of bad luck finally shows up.
And that's really what I want to leave you with today. A new question to ask yourself. The next time you see someone with a spectacular track record of success, don't just be impressed by that one visible result. Ask yourself, what other outcomes were possible? What about all those other alternative histories that we can't see? It'll shift your focus away from that seductive illusion of certainty and toward the humbling and frankly far more useful reality of chance.
All right, let's get right into it. Every single person who invests, whether they really think about it or not, makes one fundamental choice. Are you playing offense, trying to hit home runs, or are you playing defense, where your main goal is just to stay in the game? Today, we're going to explore why that second option, playing a really smart defense, might just be the secret to a long, successful career in the markets.
I love this old Wall Street saying. It just cuts right to the chase, doesn't it? It perfectly sums up this tension between chasing those massive, thrilling returns and the much less glamorous, but way more powerful act of simply surviving. This quote really forces you to face a tough reality about what it takes to actually last long enough for compounding to work its magic. So let me ask you straight up. When it comes to your own money, what gets your heart pumping more? The idea of a huge gain or the quiet relief of knowing you haven't lost what you've worked so hard for? I mean, of course, the easy answer is, well, both. But in the real world, you can't really max out both at the same time. You have to lean one way or the other. A choice has to be made. So here's our game plan. We're going to break down this defensive philosophy piece by piece. We'll start with this core dilemma, then look at a fantastic sports analogy involving tennis. After that, we'll see why soccer is an even better metaphor. Then we'll get really practical and talk about the margin of safety, tackle this idea of the paradox of greatness, and then wrap it all up with a really simple but powerful idea. Okay, first things first. To really get this defensive mindset, you have to understand what kind of game you're actually playing. And honestly, the best way I've ever seen this explained comes from a classic article written way back in 1975 by a guy named Charles Ellis. He used tennis to explain the entire world of investing. Ellis made this absolutely brilliant distinction. See, professional tennis, that's what he called a winner's game. The match is won by the person who hits the most incredible pinpoint shots that their opponent can't possibly return. But amateur tennis, the kind you and I play, that's a loser's game. In a loser's game, the person who wins is usually just the one who makes the fewest mistakes. They just focus on getting the ball back over the net, again and again, until the other guy messes up. And that's the whole idea right there. Victory doesn't come from your spectacular moves, it comes from your opponent's blunders. So, this leads to the million-dollar question, which game are we playing? Are we the pros of the stock market, hitting financial aces left and right? Or are we the weekend warriors, just trying not to hit the ball into the net? Well, the tough truth is, for almost every single one of us, investing is a loser's game. And why is that? Well, because unlike a pro on a perfectly predictable court, we investors are playing in total chaos. The market is full of bad bounces, things you just can't see coming. The rules feel like they're always changing, and the behavior of all the other players completely changes the game from one moment to the next. You can do everything right, and you can still lose the point. Trying to play a pure offense in that kind of environment isn't just tough, it's practically asking for trouble. Now, the tennis analogy is great, but let's take it a step further with another sport that I think is an even better fit for investing. Let's move from the tennis court to the soccer field. Think about American football for a second. It's a game of specialists, right? When your team is on offense, you send out your offense. When the other team gets the ball, you swap them all out for your defensive squad. But investing, it's not like that at all. It's like soccer. You have the same 11 players on the field for the whole 90 minutes. Those same players have to score goals, and they have to sprint back to defend. They have to do it all. And that is the perfect picture of your investment portfolio. You don't get to call a timeout when the market turns sour and swap in your defensive stocks. The portfolio you build has to be able to handle everything from day one. It has to be versatile enough to play both offense and defense, because you never know when the game is going to switch from a bull market to a bear market. Okay, so this all sounds good in theory, but how do we actually do it? If we're building a team that has to play defense, what's our number one strategy? Well, it's a concept made famous by Benjamin Graham and his student, Warren Buffett. It's called the margin of safety, and this is the single most important tool in the defensive investor's playbook. So what is it? Put simply, the margin of safety is your buffer. It's your room for error. It's a cushion you intentionally build into every investment to protect yourself when, and it's always when, not if, you get something wrong. It's an admission that you can't predict the future and that your own analysis might not be perfect. It's not just a hunch, it's a real, tangible number. Let's make this super simple. Imagine you've done all your homework on a particular stock. You've read the reports, you've analyzed the business, and you conclude that one share of this company is truly worth $100. That's its intrinsic value. Okay, so it's worth $100. An offensive-minded investor makes you trading at 95 and think, great, I'll buy it, hoping for a small gain. But the defensive investor, they're patient. They wait for some bad news, for a market panic, and they buy that same $100 asset when it's on sale for $70. And that $30 gap, that's everything. That is your margin of safety. Now, if it turns out your analysis was a little too rosy and the stock is only worth $80, well, you can still make money. If the market totally panics and things get worse, your loss is cushioned. It's like having a built-in shock absorber for every single investment you make. At the end of the day, it all boils down to this one simple truth. A low price is the ultimate defense. Insisting on paying less than what something is worth is the best protection you can have against an uncertain future, and frankly, against your own mistakes. Now, I know what you might be thinking. Okay, this all sounds really safe and cautious, but does playing defense mean I have to settle for boring, mediocre returns? Can you ever really achieve greatness by playing it safe? That's a really fair question, and it brings us to a pretty interesting paradox. You know, this is one of those fortune cookie sayings that's actually kind of true, and it cuts both ways. Of course, being cautious helps you avoid making big, stupid mistakes, but it also might keep you from hitting that one spectacular, life-changing investment. There is absolutely a trade-off. But here's where the paradox comes in. If you look back at all the professional money managers whose careers have flamed out over the years, the ones who were forced to hang it up, it's almost never because they didn't have enough big wins. Their careers end because they strike out. They just swing for the fences one too many times, and those big losses eventually take them out of the game for good. It turns out that survival, a long career, isn't about how big your winners are. It's about limiting how often and how badly you lose. So, where does all this leave us? We've talked about playing a loser's game, about building a portfolio like a soccer team, and about the critical importance of a margin of safety. When you put it all together, it leads to a very simple two-word philosophy that might just be the most powerful winning strategy there is. Invest scared. Now hold on, this does not mean being paralyzed by fear. It's not about stuffing your cash under the mattress. It's about investing with a deep, profound sense of humility. It's about being constantly aware of all the things you don't know and all the things that could go wrong. Think of it as prudence, not panic. So, what does investing scared actually look like day to day? It means your first thought is always about the downside, about the possibility of loss. It means you humbly accept that there are things happening that you don't know about. You always, and I mean always, insist on an adequate margin of safety before you buy anything. You build your portfolio assuming that bad things will happen eventually. And maybe most important, you have a core belief that if you just focus on avoiding the big losers, the winners will eventually take care of themselves. And ironically, that defensive mindset just might be the best offensive strategy you'll ever have. All right, let's get right into it. You know, when we talk about investing, everybody's always hunting for that next Amazon, that next big home run. But what if I told you the real secret to getting wealthy over the long haul isn't about swinging for the fences? What if it's actually about just not striking out? Today, we're going to dig into the art of avoiding those huge portfolio-killing mistakes. It's a whole different way of looking at the game, and we're going to start with a little bit of wisdom from one of the greats. And there it is, from the man himself, Warren Buffett. This quote, this is basically our North Star for this whole conversation. It's a total mindset shift, right? Instead of just chasing the wins, we're going to focus on playing defense. We're going to learn how to build a portfolio that can actually survive the tough times by spotting and dodging the traps that sink most people. So here's our game plan for today. We're going to start with the most important thing. Then we'll get into the two kinds of errors you can make and really dig into something called the failure of imagination. We'll pull some lessons from a big crisis, talk about mistakes of action versus inaction, and wrap it all up with the wisdom of patience. Let's jump in. All right, section 1, the most important thing. And really, it boils down to this. Avoiding big losses is way more important than chasing huge gains. This is the bedrock idea. It's not about being scared or stuffing your money under a mattress. It's about understanding that survival is the name of the game. If you want to build wealth that actually lasts, making loss avoidance your #1 job is, well, it's everything. And this right here really gets to the heart of it. Think about it. If you take too little risk, sure, you might underperform. Maybe your friends are bragging about their hot stock picks and you feel a little left out. That's a bummer, but you're still in the game. But if you take on way too much risk, you can get wiped out. I mean, completely. And that's not just a paper loss. That's a real, permanent loss of capital that you can never get back. See the difference? One is a bruised ego, the other is a knockout punch. Okay, so let's move on and actually start charting these dangers. If we're going to avoid the pitfalls, we've got to know what they look like, right? And when you boil it all down, the mistakes that cost investors a ton of money really fall into two big buckets. So here they are. On the one hand, you've got your analytical or intellectual errors. These are, mistakes with the numbers. You used the wrong data. Your spreadsheet had a bug. Your model was just flawed. It's a problem with the math. But on the other hand, you have the psychological and emotional errors. And honestly, these are the real killers. This is when your own brain turns against you. We're talking about greed. We're talking about fear, about ego, and that powerful, powerful urge to just follow the herd off a cliff. All right, let's zoom in on a really specific kind of intellectual error, but it's one that is so big, so powerful, it's at the core of almost every financial disaster you can think of. We're talking about the failure of imagination. This isn't about getting your math wrong. This is about not even being able to imagine that a hurricane is possible because all you've ever seen are sunny days. It's the danger of what you just don't see coming. So what does that mean, really? A failure of imagination?
It's when we get locked into thinking about what's likely to happen, and we completely forget to think about what could happen. We get so focused on the normal day-to-day that we don't consider the wild, extreme events. Or even worse, we think about them, but we totally downplay how devastating they could be. It's like building a ship that's perfect for a calm lake, but it'll snap in half in a real storm.
So why does this happen to us? Why do we fall for this? Well, there are 3 really powerful psychological drivers. First, we just extrapolate the past. Things have been going up for 5 years, so we just assume they'll keep going up. It's human nature. Second, our financial memories are shockingly short. We just forget. The dot-com bust, the crash of '87, it all feels like ancient history that could never happen again. And third, and maybe the most powerful of all, is this siren song of easy money. When it looks like everyone around you is getting rich quick on some new fad, all caution, all skepticism just goes right out the window.
Look, this isn't just some abstract theory. Let's talk about a real-world example that I'm sure many of us remember all too well, the 2008 financial crisis. I mean, this was the absolute textbook case of a collective failure of imagination, and it nearly brought the entire global financial system to its knees.
So, how was it a failure of imagination? Well, get this. The entire multi-trillion-dollar global mortgage machine was built on one single solitary belief, that U.S. home prices as a whole could never, ever go down. That was it. That was the linchpin. And because everyone believed it couldn't happen, they took on more and more risk, which is exactly what made it happen. People also completely misunderstood how interconnected everything was. They thought their portfolios were safe and diversified, but they didn't realize that in a real panic, all correlations go to 1. Everything falls at the same time. And pretty much nobody could imagine the knock-on effects that a bunch of bad mortgages in Florida could lead to the collapse of a 150-year-old investment bank like Lehman Brothers. It was just unthinkable. You know, they say the market is a very expensive teacher, and boy, did 2008 teach some brutal lessons. But the wisdom that was forged in the fire of that meltdown is absolutely timeless. So let's unpack the survivor's toolkit from that crisis, because these lessons are just as critical right now as they were back then. First up, let's talk about capital and risk. Here's a huge lesson. When there's too much money sloshing around the system, it always finds its way into the wrong places. Always. When capital is easy to get, discipline just evaporates. And when that money goes where it shouldn't, you can bet bad things are going to follow. It's during these times that a widespread disregard for risk becomes the single greatest risk of all. People get lazy, they stop doing their homework, and that lack of due diligence is what leads directly to catastrophic losses. Okay, next lesson: psychology and innovation. During those really heady, optimistic times, money just pours into whatever is new and shiny and innovative. The problem is, a lot of these things end up being junk. And for a while, in the short run, pure psychology, greed, hype, the story, can totally overwhelm the actual numbers. The fundamentals don't seem to matter. But here's a lesson you can take to the bank. Excess is always correct. It's like a law of financial gravity. When a market is priced for absolute perfection, it is set up for a major fall, because perfection never lasts. And the last big lesson here is about models and leverage. First, we learned that there are hidden fault lines in the market. Things you think are totally unrelated can all be connected, and they can all collapse together. And those fancy computer models the experts use, they're all built on past data. They're basically trying to drive by looking only in the rearview mirror. So when the market changes, which it always does, the models break, usually at the worst possible moment. And then there's leverage, debt. It's so seductive. But you have to remember, it doesn't add any real value. It just acts like a giant magnifying glass on your results. It can turn a good outcome into a great one, sure, but it turns a bad outcome into an absolute, unmitigated disaster.
Okay, so we've looked at the big picture traps, the intellectual and emotional ones. Now let's get really practical and talk about the actual mistakes we make with our actions. This is all about knowing when to pull the trigger and, just as importantly, when to keep your hands in your pockets. It really breaks down into 2 types of errors. So on the left, you've got your errors of commission. These are the things you actively did but shouldn't have. You know, you bought that hot stock right at the peak of the bubble, used too much leverage, you chased a trend. These are the mistakes of greed, and they're most common when the market is euphoric. Then on the right, you have errors of omission. These are the opposite. They're the things you should have done but didn't. You were too scared to buy a fantastic company when it was on sale during a crash. You sat in cash for years while the market ripped higher. These are the mistakes of fear, and they dominate when everyone is pessimistic. So what's the takeaway here? It's that you have to be a bit of a psychologist.
You need to step back from the day-to-day chaos and just read the room. And then you ask yourself this incredibly important question. What is today's mistake? Think about it right now. What is the dominant emotion out there? Is it greed? Is everyone euphoric, convinced they can't lose? If so, then today's mistake is probably an error of commission, doing something stupid. Or is the mood one of absolute terror? Is everyone panicked and selling? Then today's mistake is probably one of omission, being too frozen by fear to act. Asking this question helps you lean against whatever way the wind is blowing. All right, so we have covered a lot of ground. We've mapped out the intellectual traps, the emotional minefields, the failure of imagination, and the errors of doing too much versus doing too little. And this all leads us to our final point. And honestly, it might be the most powerful tool in your entire kit. It's certainly the most underrated.
Just read that for a second. When there's nothing particularly clever to do, the potential pitfall lies in insisting on being clever. This is so, so important. There are long stretches of time when the market is just kind of okay. Nothing's screamingly cheap, nothing's insanely expensive. And in those moments, the pressure to do something, to tinker, to make a move is huge. We feel like we have to be clever. But the biggest mistake, the biggest pitfall, is trying to force a brilliant move when there isn't one to be made. Sometimes the absolute smartest thing you can do is nothing at all. True wisdom isn't just about making good moves, it's about having the patience not to make bad ones.
So that's where we'll leave it. We've basically handed you a map that shows where all the biggest dangers, all the deepest potholes in investing are located. The real question now is, what are you going to do with it? How are you going to navigate the market we're in right now? And think about that key question we talked about. Based on everything you see and feel today, what is today's mistake? Are people making errors of commission, being too greedy, or are they making errors of omission, being too fearful? Seriously, take some time to think about that, because your answer could be the single most important factor in your success from here on out. Okay, so you're an investor. What's the number one goal? Beat the market, right? It's what we all shoot for, getting better than average returns. But, and this is a big but, what if that whole idea, just beating the market, is kind of misleading? What if there's a much sharper, a much more powerful way to think about what success really looks like? Well, that's exactly what we're going to dig into.
So here's the plan. We're going to start by questioning that whole beat the market idea. Then we'll get into the nitty-gritty of beta and alpha. After that, we'll figure out how to spot real skill versus just, a particular style. And we'll wrap it all up with something called the asymmetry advantage, which, trust me, is going to become your new North Star for investing.
All right, first up, beyond beating the market. We hear it all the time. Beat the market, beat the market. It sounds like the absolute finish line, doesn't it? But what if we're running the wrong race? Is just getting a bigger number really the prize we should have our eyes on? So, this really gets to the heart of it all. What does it truly mean to add value in investing? I mean, when you see a portfolio that did really well, what are you actually looking at? Was it just dumb luck? Did someone just make a super risky bet that happened to work out this one time? Or is it something real? Is it genuine, repeatable skill? Because figuring that out, well, it changes absolutely everything. Look, anybody can match the market. Seriously, you just buy an index fund and call it a day. That's a totally passive strategy. The real trick, the real challenge, is to consistently do better. And that doesn't just happen. It's not about luck. It's about adding real, tangible value because you have some kind of superior insight. This is where we shift from just going along for the ride to being an active, skillful investor. Okay, so to really get a handle on what that superior insight looks like, we first have to peel back the layers. We need to strip away all the stuff in a portfolio's return that has nothing to do with skill. And that journey starts with a concept called beta. The easiest way to think about it, it's basically the volume knob for your portfolio's connection to the market. I know. Beta sounds a little technical, maybe a bit academic, but the idea behind it is actually super simple. All it does is measure how much your portfolio swings up or down when the whole market makes a move. So if you think of the market as the music playing in the background, your beta is the volume knob. A beta of 1, you're moving perfectly in sync with the music. A beta over 1, you've cranked the volume up, you're going to get bigger swings, more volatility. And a beta under 1, well, you've turned it down for a quieter ride. And this is so important to get. Beta is a total double-edged sword. Let's say you're an aggressive investor with a high beta. When the market is booming, you're going to look like a genius, right? Your returns are amplified. But when the market tanks, you're going to get absolutely crushed, way more than everyone else. On the flip side, if you're a defensive, low-beta investor, you'll feel great when the market's down because you're losing less. But you'll be kicking yourself when it's soaring because you're lagging behind. See? It's a perfectly symmetrical trade-off. This isn't skill, it's just a choice of style. Okay, so if beta is just about how much market risk you're dialing up or down, where does the actual skill come in? Well, that, my friends, brings us to the search for alpha. This is the real secret ingredient. Whoa, okay, don't panic. Don't let the math formula scare you off. It's way simpler than it looks. All this equation is saying is that your total return, that's why, is made up of two basic things. The first part, the beta x, is just the market's return adjusted by your volume knob, your beta. Simple enough. The second part, that's alpha. Alpha is, well, it's everything else. It's the extra bit of return that you can't explain just by looking at the market. You might even call it the magic. To put it simply, alpha is the value you add. It's the return that comes directly from that superior insight we were talking about before. It's the payoff from brilliant stock picking, from a manager's unique skill. Now, you'll find plenty of academics who'll argue that in a perfectly efficient market, true alpha is basically a myth, that it doesn't exist. But I'll tell you what, for the best investors on the planet, chasing alpha is the entire game. It's everything. Okay, that's enough theory for now. Theory is great, but let's make this real. Let's make it tangible. We're going to walk through a couple of examples side by side so you can see with your own eyes the difference between style, which is all about beta, and true skill, which is all about alpha. All right, let's start with our baseline. Look at this chart. In every single period, the portfolio's return is exactly the same as the market benchmark. Every single time. This is your classic S&P 500 index fund. The beta here is exactly 1, and the alpha, well, it's a big fat 0. No value was added. You just got whatever the market decided to give you, for better or for worse. Okay, now check this one out. At first glance, this manager looks like a rock star, right? When the market's up 10, they're up 20. The market pops 20, they're up a whopping 40. You'd be thrilled, but hang on a second. Look at period 4. The market dips by 10, and this portfolio plummets by 20. You see what's happening? This isn't skill. This is just a beta of 2. They've just cranked the volume knob to 11. It's an aggressive style, for sure, but there's absolutely no alpha to be found here. But this is where it gets really interesting. Notice how this portfolio's returns don't follow a simple, perfect multiple anymore. In the good years, yeah, the manager does great. But let's go back to our problem spot, period 4. The market drops 10%, and this portfolio, wait for it, actually goes up 2%. Now that is something beta can't explain. That's not just a volume knob. That, my friends, is pure alpha. That is genuine skill at work, protecting your money when things go wrong. And this is really the whole point. You can't just look at a big, flashy return number and call it a day. That manager who was up 40% in that one example, they weren't necessarily any better than a manager who was up, say, 15%. You have to dig deeper. You have to ask, how did they get that return? What kind of risk did they take to get there? Was it just a stylistic choice to be aggressive, or was there real skill involved? It's all about risk-adjusted return. That's the name of the game. Okay, so this all leads us to the absolute pinnacle of this whole idea. Once you get good at separating style from skill, once you can tell the difference, then you can start aiming for what is pretty much the holy grail of investing, something called the asymmetry advantage. And this matrix, this just lays it all out perfectly. Let's start with the top row, the world without skill. Over on the left, the aggressive guy. He gains a ton, but he also loses a ton. Symmetrical. On the right, the defensive guy. He doesn't lose much, but he doesn't gain much either. Again, totally symmetrical. Their performance is just a direct result of their style. But now, look at the bottom row. The world with skill. This is where things get exciting. The skilled, aggressive investor gains a lot, but somehow manages not to lose nearly as much on the downside. The skilled defensive investor loses very little, just like before, but now they're capturing a really nice chunk of the upside. Their performance is no longer symmetrical, it's asymmetrical. This is where real value is created. Here's a great quote from the folks at Oak Tree Capital that just nails the defensive side of this idea. It's our goal to do as well as the market when it does well, and better than the market when it does poorly. Now, that sounds almost modest, doesn't it? But think about what it really means. To keep up when the market's flying high, you need some market exposure. You need some beta. But that same beta means you should fall when the market falls. So if you can hang with the market on the way up, but somehow lose less on the way down,
There's only one explanation for that. It's skill. It's alpha. So let's just put a fine point on it. What is this asymmetry we're seeking? It means you capture a higher percentage of the market's gains. It means you suffer a lower percentage of the market's losses. It means you finally get to break that symmetrical, two-edged sword of risk and reward that traps most investors. And this is the key, it can only be achieved through that secret ingredient we've been talking about this whole time. Superior skill. Alpha.
All right, let's pull all these threads together. We started with this really simple idea, beating the market, and we've basically taken it apart and put it back together in a much smarter, much more powerful way. This is a whole new framework, a new North Star to guide you.
So here it is. This is the single biggest takeaway. Your new investing North Star is this. The ultimate goal is asymmetry, getting better performance on the upside than you get on the downside, relative to what your chosen style alone would produce. So, from now on, don't just ask, did I beat the market? Instead, ask yourself, did I achieve asymmetry? Did my portfolio's performance go above and beyond what my beta would have predicted? That is the true measure of whether you've added value. So I'm going to leave you with a final thought, a question to carry with you. The next time you see some fund manager on TV bragging about their incredible returns, or shoot, even when you're looking at your own portfolio after a really good year, I want you to just pause for a second and ask yourself this one simple question. Am I just seeing the reward for taking on a whole bunch of risk, or am I actually seeing the results of genuine skill? The good news is, now you have the framework to figure that out.
You know, when we talk about investing, our minds immediately jump to finding the next big stock or some secret formula for huge gains. But what if I told you the single most important thing for success has nothing to do with that? What if it's all about your mindset? Today, we're going to dig into maybe the most underrated but absolutely crucial part of investing, setting reasonable expectations.
Okay, so let's just start with this quote right here, because it really cuts through all the noise. The real danger of dreaming too big isn't just disappointment. No, it's that it makes you do things, it pushes you to take on massive, hidden risks you don't even see coming. This is the root cause of almost every major investing blow-up. So let's unpack what reasonable actually looks like and how you can stay out of that trouble.
So here's the game plan for this explainer. We're going to start with what a reasonable return even is. Then, we'll look at where those crazy high returns actually come from. We'll dive into the ultimate cautionary tale, Bernie Madoff. Then I'll give you a simple toolkit to keep yourself safe. We'll talk about why trying to be perfect is your enemy, and we'll wrap it all up by reframing the entire goal around this idea of a good enough return. Let's get into it.
Look, every good journey needs destination, right? And investing is no different. You've got to know what you're trying to do. But just having a goal, that's not enough. It has to be grounded in reality. So the first, most basic question we have to ask is, what is a reasonable return, anyway?
Okay, check this out. I think this table really puts things in perspective. Historically, if you're aiming for returns in the single digits or maybe the low double digits, you're in a good spot. That's reasonable. But look how the language changes. High teens? That's not just reasonable, that's very special. It's rare. And 20% plus? That's the playground of the best of the best. The top pros in the world, and even they can't do it year after year. So if you're expecting that for yourself, you're honestly just setting yourself up for failure, or even worse, for taking some really dumb risks.
So if the norm is in that single or low double-digit range, where do these spectacular front-page news kind of returns come from? Well, it's not magic. The source material calls them unnatural, and they almost always come from a very specific and pretty rare set of circumstances.
Right, so here are the 5 paths to those unnatural returns. 1, you buy when the world is ending and prices are in the toilet. 2, you happen to have some truly world-class genius-level skill. 3, you take on a stomach-churning amount of risk. 4, you use a ton of leverage, that's borrowed money, to juice your gains. And 5, well, you just get unbelievably lucky. But see the problem here? Depressed markets don't last forever. Genius-level skill is by definition incredibly rare. Massive risk and leverage can wipe you out just as easily. And luck, you can't build your retirement on luck.
Now, let's see how this all plays out in the real world with the biggest, most insane example you can think of, Bernie Madoff. This is exactly what happens when thousands of people throw reasonable expectations out the window. It wasn't just a financial failure, it was a psychological one. People wanted to believe the story so badly, they couldn't imagine it was all a lie.
And here's the really brilliant and twisted part of the Madoff scam. The returns he promised, they weren't astronomical. He was telling people he could make them 10 to 12% a year.
Now, if you think back to our chart, that number is right on the edge of reasonable. It didn't scream scam. The lie wasn't in the size of the return.
No, the lie was in the consistency. This slide shows it perfectly. On the left, that's reality. The market might average 10% over time, but it's a wild ride to get there. Huge up years, brutal down years. On the right, that was Madoff's fantasy land. Smooth, steady gains, month after month, year after year. A down month was almost unheard of. He was basically selling the returns of the stock market with the safety of a government bond. And that, my friends, simply does not exist.
And this is why, when you apply that 5-point framework we just talked about, the whole Madoff story just completely falls apart. Could you explain his returns with any of those 5 things? Absolutely not. Was it a depressed environment? Nope. His returns were steady for 20 years through bull markets and bear markets. Was it extraordinary skill? Well, his strategy was a secret nobody could figure out or copy. Was he taking on huge risk? He claimed he wasn't. Was he using leverage? Not according to him. So was it just good luck? Come on. Nobody's that lucky for 2 decades.
At the end of the day, it's really this simple. There was no logical, rational way to explain his results. And his investors, who are blinded by the promise of an easy win, just failed to ask the most basic question of all. They failed to step back and say, wait a minute, this sounds way too good to be true.
So how do we make sure that never happens to us? It's not about being a Wall Street genius. It's about having a couple of really solid mental tools. Let's give you 2 simple but incredibly powerful questions that can be your best line of defense against this kind of stuff.
Question number 1. This is it. The Madoff killer. It sounds so simple, almost like a cliche, I know, but it is the most powerful weapon of skepticism you have. Before you get all excited about some promise of high, easy money, you have to stop, and you have to ask yourself this question seriously. If the answer is even a little bit, yeah, maybe, you need to slam on the brakes and start digging.
And here's the second question, which is a little more subtle. When someone's offering you this can't-lose, guaranteed profit opportunity, you have to ask yourself, why me? I mean, really think about it. If this thing is so amazing, why are they telling you about it? Why aren't they just quietly keeping it all for themselves and their families? Why do they need your money? This question cuts right through the sales pitch and usually exposes how shaky the whole thing really is.
All right, so we've got our tools to keep us safe from the really bad stuff. Now, let's switch gears and talk about building a smart real-world strategy. A huge source of unreasonable expectations is this desire we all have for perfection, especially when it comes to timing the market.
Oh man, this is the thing that gets so many investors in trouble. We see something we want to buy, but the price is dropping, so we get scared. We tell ourselves, I'll just wait. I'll wait till it hits the absolute rock bottom, and then I'll jump in. It sounds so smart, right? But it's a total fantasy.
Because here's the simple, hard truth about the bottom. It's not a flashing light you see in the moment. It's an event you can only identify with 100% certainty by looking in the rearview mirror, weeks or months later. When prices are crashing, there is no bell that rings to tell you, this is it. It won't go any lower. Thinking you can spot it in real time is just pure ego. And this brings us to this incredible piece of wisdom from Voltaire. If you insist on perfection, if you're only willing to buy at the absolute perfect bottom, you're basically setting yourself up to do nothing. You'll sit on the sidelines and miss a ton of really good opportunities while you wait for that one perfect moment you can never actually be sure has arrived. So what do you do instead? You embrace imperfection. You find the courage to buy a great company or a great asset while the price is falling. You know, when everyone else is panicking and yelling, "Don't catch a falling knife," that's often where the real bargains are hiding. Sure, you might not nail the exact bottom, but if you buy a quality thing when it's on sale, chances are you're going to do just fine in the long run. And all of this leads us to our final and, I think, most important point. We have to completely change the way we think about our goals in investing. The real objective, it's not what most people think it is. Just listen to this. This is the inner monologue of the typical investor. It's a one-way street of more, more, more. I need 8, but then would be better, 15 would be great, 30% would be amazing. There's absolutely zero thought given to how you'd get those higher returns or the insane risks you'd have to take. It's a mindset that only sees the upside and is totally blind to the downside.
Now contrast that with this, the voice of a prudent investor. The starting point is the same. I need 8%, but the thinking after that is completely different.
This investor understands that there's a limit. They know that reaching for more means taking on more risk, and they've decided ahead of time, these are the risks I'm not willing to take. They choose safety over greed.
And that right there is the whole point of this entire explainer. The goal of investing is not to squeeze out every last drop of potential return. The real goal is to get a good enough return, one that lets you hit your financial goals while staying inside a level of risk that lets you sleep at night. That's it. That's the whole game.
So I'll leave you with this to think about. Take a really honest look at your own goals, your own expectations. Are they built on the kind of reality we've been talking about today? Or, if you're really honest with yourself, are you chasing a return that's just a little too good to be true? Because answering that question for yourself, well, that's the most important thing you can possibly do. Thanks for joining me.
You know, Howard Marks has famously talked about dozens of most important things when it comes to investing. And it's brilliant stuff, but if everything is the most important, well, where on earth do you even begin? That's exactly what we're going to tackle here. We are going to boil down all that incredible wisdom into a single powerful framework, a pyramid, really, that you can use to build a truly superior investment philosophy from the ground up. So let's start building.
This is the big one, isn't it? This is the question that keeps us all up at night. Forget the hot stock tips. Forget the secret formulas. Superior results, the kind that last, they don't come from a trick. They come from having a superior mindset, a way of thinking that is tough, repeatable, and built on rock-solid principles. And that is exactly what we are going to construct piece by piece right now.
And here's our blueprint, the pyramid of superior investing. You know, like any strong building, it all starts with a solid foundation. And for us, that's understanding value. From there, we'll build up, layer by layer. We'll look at the critical relationship between price and value, then the emotional roller coaster of market psychology, the absolute necessity of controlling your risk, and finally, we'll reach the very top, the peak, where we define what gives a truly great investor their edge. All right, let's lay that first stone.
So here we are, at the base of our pyramid, layer 1. And let me tell you, this concept underpins absolutely everything else we're going to talk about. Before you can make a single intelligent move, whether you're buying or selling, you have to be able to answer one simple question. What is this thing actually worth?
So what is this intrinsic value we're talking about? Well, it's definitely not the stock price that's flickering on your screen second by second. Think of it as the real, fundamental, underlying worth of a business. It's the stuff you could touch, the factories, the cash in the bank, the patents. But really, the most important part is its power to generate more cash year after year into the future. In a crazy, chaotic market, this idea is your anchor. It's what keeps you grounded in reality.
And this, right here, is where we start to separate the amateurs from the pros. See, it's not enough to just plug some numbers into a spreadsheet and calculate a value. Anyone can do that. To get superior results, your insight into that value has to be superior. You've got to see something that the rest of the market is missing. Maybe you analyze the financials more deeply, or you just understand the industry better. This is where your first real competitive advantage is born. Okay, so we've laid the foundation. We have a solid grasp on how to figure out what something is worth. Now we build the second layer of our pyramid, and this is all about the relationship between that value and the price you actually pay. This, my friends, is where a good analyst becomes a great investor.
And hey, don't just take my word for it. Look at this. Another investing legend, Joel Greenblatt, calls the relationship between price and value the foundational principle. He didn't say a principle, he said the principle. If you can get this right, you are well on your way. If you get it wrong, well, nothing else really matters.
This illustrates the key distinction we have to make perfectly. A good asset, a fantastic company that everybody knows is great, that's usually obvious to everyone. But a good buy, that's something different. A good buy is when you can purchase that asset for way less than it's truly worth, simply because the market's perception is off. The superior investor doesn't just hunt for good assets, they hunt for good buys.
So why is this idea of buying below value so incredibly important? Well, because it's like a 2-for-1 deal. First, it gives you a clear and dependable path to profit. The price eventually has a tendency to rise and meet its true value. And second, it builds in a safety net, what we call a margin of error, just in case you're wrong or things go bad. It's your best offense and your best defense, all in one single move. All right, we have the analytical layers of our pyramid in place. We've got value and we've got price, but now we have to add the human element. And that's where things get wild, unpredictable, and often completely irrational. We're talking about market psychology. Howard Marks uses this absolutely brilliant analogy of a pendulum. He says the market is just constantly swinging between two emotional extremes. Over on one side, you've got total euphoria and greed. That's when everyone has a terrible fear of missing out. The price just feels like it can only go up. And then, whoosh, it swings all the way to the other side, absolute fear and pessimism, where everyone is terrified of losing money and is scrambling to sell. The herd just gets whipped back and forth, and what do? They consistently buy at the top and sell at the bottom. Your job is to understand this swing, stand apart from it, and not get swept away.
And this is one of my all-time favorite lines from Marx. It just perfectly captures the danger of following the crowd. The best opportunities, the real gems, they exist at the beginning of a trend, when nobody wants it, when it's unpopular. By the time it's obvious and everyone is jumping on the bandwagon, well, the opportunity is usually long gone, and the risk is at an all-time high.
So the takeaway here is a beautifully simple, actionable rule. Use the market's mood as your contrarian indicator. When the headlines are glowing, when no one seems to have a care in the world, that's your signal to be cautious, to be on high alert. And when there's blood in the streets, when everybody's panicking and selling indiscriminately, that is your signal to get aggressive and start looking for those incredible buys.
We are now adding the fourth layer to our pyramid. And let me tell you, this one is all about playing defense. This is the safety net that protects the entire structure you've built. Because look, great investing isn't about hitting home runs in the good times. It's about surviving the bad times so you can stay in the game long enough to win. It is all about controlling your risk.
First things first, we have to get our definition straight. In a classroom, risk is often defined as volatility. You know, how much a price bounces up and down. But as Marx points out, for a real-world investor with real money on the line, that's not what keeps you up at night. The risk you truly care about, the one that can end your career, is the risk of permanent capital loss. The risk that your money vanishes and just never comes back. That is the real enemy.
This quote from Marx is one of his most famous, and for very good reason. It perfectly illustrates the hidden danger of just relying on averages. The market stream isn't always a comfortable 5 feet deep. There are unexpected, sudden 6-foot holes, and if you've only prepared for the average, you drown. That is precisely why you need a margin for error, to help you survive those unexpected deep spots.
So how do we actually build this fortress, this margin for error? Well, the playbook is pretty straightforward. First, you insist on tangible value today, not some rosy forecast about a distant, uncertain future. Second, just like we covered, you buy only when there's a significant discount to that value. Third, and this is a big one, you avoid leverage, borrowed money, because it has a nasty habit of turning small, manageable mistakes into catastrophic, portfolio-ending disasters. And finally, you diversify intelligently. That doesn't just mean owning a lot of things, it means owning different types of assets that won't all go down at the same time.
Okay, we've done it. We've laid the foundation, we've built the main structure, and we've installed the safety net. We've officially reached the summit of our pyramid. This is where all the other layers come together to create that final, elusive piece of the puzzle, the superior investor's edge.
Think about it. Anybody can look like a genius in a roaring bull market. You know the saying, a rising tide lifts all boats. But it's when the tide goes out that you see who's been swimming naked. So how do we separate genuine, repeatable skill from just dumb luck or being in the right place at the right time?
The answer really can be found in one powerful word: asymmetry. A truly superior investor structures their portfolio so that the potential upside is just massively greater than the potential downside. It's not just about being right more often than you're wrong. It's about making sure that when you win big, and when you lose small. It's about participating in the good years while protecting your capital from getting absolutely crushed in the bad years. That right there is the ultimate mark of skill.
And where does this edge, this asymmetry, actually come from? Well, it comes from focusing on the knowable. The best investors pour their energy into understanding specific companies, specific industries, specific securities, things you can actually analyze and develop a real insight into. They don't waste their time and energy trying to predict the unknowable, like what the economy is going to do next year or where interest rates are headed. Their edge is micro, not macro.
And this final piece of wisdom from Marx just ties a beautiful bow on our entire pyramid. See, it's not about having a crystal ball. It's about being a great risk manager. You have to understand the full range of outcomes that could happen, have a sense of the probabilities of each one, and then, and this is the absolute key, decide if the price you're paying today is giving you an adequate reward for having to deal with all that uncertainty.
So there you have it. Our pyramid is complete.
From that solid foundation of value, through the crucial layers of price, psychology, and risk, all the way to the summit of skill. Every single block is essential. And that brings us to the final question, but this one isn't for me to answer, it's for you. Looking at this entire framework, which one of these most important things is the most important for your journey right now? Thanks for joining me.